be very interesting to see what the earnings reports are going to be like. It's not great to have the entirety of your capital in 7 names.
It really does accentuate that need for diversification.
When you have leaders in technology, they tend to stay leaders.
Big tech, you've got growth at a reasonable price. I'm not necessarily worried about the valuations here.
These big tech names, though, are not an obvious loser to me.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now as we come into Wednesday within 1% of all-time highs on the S&P 500. Equity futures, the bounce continues, up another 1% on the S&P. On the Nasdaq, up by 0.4. Going into a monster day. The first Fed decision of 2025 later on this afternoon. 30 minutes after that, you'll hear from Chairman Powell. And then the earnings, Microsoft, Meta, and Tesla.
I thought you were going to say, and then the main event, which is earnings from Microsoft and Meta and Tesla, because as much as we want to hear from Fed Chair Jay Powell, and as much as people are going to be parsing through the nuances of how he carries himself and how he discusses Donald Trump and what kind of facial expressions he has, really it all is going to be about big tech, how much they plan to spend on capital expenditures, and how they plan to adjust and adapt their artificial intelligence spend and development in light of some recent efficiencies.
How they defend this on the earnings call will be very intriguing. I'm looking forward to the Microsoft one. It's going to be a big one a little bit later on this afternoon. Then Meta. Meta only last week talked about spending $65 billion on projects linked to AI. There was this line in there that they intend to build a data center so large that it would cover a significant part of Manhattan.
They will have to justify that, and then they will have to give some sort of guidance about whether that spend is more of a one-off in terms of infrastructure now, or whether it's sort of the idea that you cannot throw enough money at the infrastructure tied to artificial intelligence. This is the distinction in the story, that the spend so far has been on the chips and the data centers. Are we shifting into a world where you have to be putting it into something else about the applications more broadly? And is that what we're going to hear potentially from the executive branch of these particular companies?
With regards to these numbers, we've talked a lot about DeepSeek and the earnings call. We haven't talked much about the earnings themselves. Demonstrating the power of earnings, ASML over in Europe. Coming out with numbers this morning, reported bookings of 7 billion euros. The estimate was for around 3.5. The stock is up over in European trading right now by close to 9%.
This is a fascinating story on several fronts. This Dutch company makes the equipment to manufacture chips. TSMC is one of their biggest customers, and China was one of their biggest customers, the biggest customers for most of the past number of years. That has shifted. And the question is, especially given that the shares are down 25% since the July peak, how much are we looking at the rest of the world taking over market share where China can no longer play? Again, the idea that these players, given that their equipment is so much in demand, can continue to do well regardless of China's presence.
Should we do some tech earnings and a little bit of Federal Reserve? Got to sprinkle in some Federal Reserve, right? I think there is a difference between a skip and a pause. And I wonder how they sort of navigate that issue. We've had a cadence that sounds like this, a 50 basis point reduction, a 25, a 25, and a lot of people think they will skip today's meeting. Is that a skip or the start of a prolonged pause?
So the distinction here being that a skip implies that there still is a downward trajectory to rates. A pause means we have no clue. A pause would be incredibly hawkish. It would basically give a sense that maybe they really are done and would edify what a lot of people are saying. Whether he indicates that, his goal today is to basically not address this question, not do anything, basically say as little as possible. Will he do his inner dove? Let's see. This is what a lot of people are going to be listening for.
The consensus on the street at the moment seems to be closer to maybe a pause than a skip. We'll see if that changes later on this afternoon. Coming up this hour, we'll catch up with Julian Emanuel of Evercore on the AI revolution, Michael Widmer of Bank of America ahead of the Fed decision, and Ahmed Khan of Morningstar as big tech earnings kick off a little bit later this afternoon. We begin this hour with stocks rising as traders await the Fed decision and earnings from big tech. Julian Emanuel of Evercore staying overweight tech on a 3-month view. While the dust settles, many of these names, particularly the semis, may remain pressured on a 3-quarter and 3-year view. You want to buy these. Julian joins us now for more. Julian, good morning.
Good morning.
I can't believe it's only Wednesday. I said on Tuesday it felt like it's already Friday. Let's get into these earnings a little bit later. You say maybe buy over a 3-quarter multi-year view. Why?
Because essentially what we saw over the last 3 days tells you that the importance of AI as a revolutionary technology that's going to advance the world is not only robust, but is an absolute imperative, okay? And the stocks reacted the way they did on Monday because of this sort of psychological displacement with regard to DeepSeek. But what it really means is that now the race is on to implement. And from our work, 2025, and the work we did almost 2 years ago now when AI first it was introduced, is that 2025 was going to be the inflection year in adoption, and this catalyzes it.
So what does that mean for sector preferences as we shift away from enablers to adopters? What does that look like?
So there has been, over the last year or two, a swath of companies across industries who constantly speak to the idea of AI. Again, a lot of it is largely anecdotal because I think there's been a reticence to talk about what cost savings looks like versus things that drive revenue. And frankly, companies are still trying to figure out what that mix looks like. But those are the companies that are forward about it, and we're going to hear a lot more. It's not just the earnings calls of the Mag 7 this period that matter. It's the earnings calls of the other companies, and those that are talking about it and telling you how they're deploying are the names you want to own.
Do you think that this is actually the tipping point that so many people were waiting for, where suddenly some of the biggest winners, and it's not just NVIDIA, it's also the power generators, which didn't recover really yesterday, are not going to necessarily benefit in the same way that they did in 2024?
There's a bifurcation going on. And, actually, if you're Jay Powell and you're Donald Trump, you like the fact that yields have come in over the last couple of days because the implication is the news that we had over the weekend in terms of DeepSeek is actually a disinflationary impulse. But the downside of that is, as a power producer, it's much more difficult to see what the next 3 years looks like. And whenever you have a company or a theme that one moment had sort of this concept of infinite growth, whatever that number was, and then all of a sudden it's infinite minus a handicap, that's punishing for the stocks.
Is that the right way to interpret the move in yields? That it was an expression of greater disinflation as a result of technological advance, or was it simply a risk-off move, knee-jerk, basically buy bonds?
Well, you would have said that, except for the fact that yields ended up on their lows yesterday, basically unchanged, with the market recovering. So I think there was certainly an element of that on Monday. But the other message, and again, obviously overnight, we've seen more rhetoric about the intention to reduce the size of government. All in, this has calmed the bond market down. And from our point of view, talking about the names in the sectors that we like, the bull market leaders, yields remaining calm is a very important part of that thesis.
It certainly depends why. And the conference board numbers yesterday weren't great. Why have we settled down on bond yields? Is it just good stuff, or is there some bad stuff in there too?
Look, even when things are going gangbusters in an economy, you can always find the 1, 2, or 3 items that are unsettling. You look deep enough, you find them. But frankly, from our point of view, you're in a mode where, and again, I'll go back to your introduction, we think it's skip, not pause.
Okay, why?
Because basically the trend towards inflation, if you think about it, the last several months, very much like the spring of 2024, you had a couple of months in there where the thesis was questioned about the trend of travel of inflation. You paused, but yet it kept going. And the weakening of some of those data elements, continuing claims moving to new multi-year highs among them, tell you that the trend of inflation moving lower is intact, and that's what the Fed wants.
Is that call trade dependent? We'll head down to Washington and catch up with Annmarie in about 5 minutes' time. Is your call on a skip and not a pause trade dependent? And what happens this weekend? Avoid tariffs or implement them?
So, very good question, and I think the answer there is if you look back, Donald Trump learned a lot from his first term in office, okay? And one of the things that he learned was that the bond market really could call the shots for the degree of policy implementation and how far you pressed once things were announced. So in that respect, there is an element of that to it. But we do think that, you go back to the original appointment of Bessent, there is an acknowledgement of the importance of financial markets and the desire not to disrupt that narrative, to be able to long-term implement policy.
We'll get into the details when we speak with Annmarie in just a moment. But you said, just in general, as a stock analyst, as an equity analyst more broadly, looking at the path of policy, it looks like basically a repeat of 2018. And yet in 2018, the S&P ended the year down 6.25%. Why is this time different?
So if you look at it, the path in 2018 was very volatile, and actually at mid-year, you were up substantially, almost double digits. And then what happened was you got to a point where the bond vigilantes stepped in. In 2018, 3% on the 10-year yield was the equivalent of 5% on the 10-year yield right now. And we've already seen, whether it's the last couple months or going back to the start of this bull market cycle, that once you get towards 5%, the markets don't like that. And so that is well known.
Which is the reason why the commentary that we will get this afternoon won't necessarily be from Mark Zuckerberg. It won't necessarily be from Satya Nadella. It won't necessarily be from Fed Chair Jay Powell. It will be from Donald Trump in response to Fed Chair Jay Powell, regardless of what he said. And if there is a pause and not a skip, if there is an indication that this is it and they are done and that, frankly, there's even a chance of them hiking rates again, how big would the tantrum be in markets?
Pretty substantial.
But you were asking how big would the tantrum be at the White House?
Well, we already know that answer. The question is, this is sort of par for the course. Don't they already have it in pre-write? They basically just press go. Anyway, carry on.
But again, the point being here that at the valuations where we are in the market, both less than perfect and or very good news is met with violent reactions. So basically, we have DeepSeek on Monday. We have a pretty substantial sell-off. But that was preceded by 10 days of literally parabolic gains, given the fact that the inflation news was so good. So where's the next 3 to 5%? Well, let's see what we hear from the White House, and let's see what the corporate, what the dialogue around DeepSeek is in these reporters this afternoon.
Yep.
But the long-term trend of travel is still higher in our view.
We'll head down to Washington in just a moment. Julian's going to be sticking with us. Equity futures right now on the S&P positive by close to 1/10%. Coming up on the programme then, we'll catch up with Annmarie in just a moment. Before we get there, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bloomberg has learned that Microsoft and OpenAI are investigating whether Chinese AI startup DeepSeek obtained unauthorized data output from OpenAI technology. Sources say that Microsoft had observed individuals that they think might be linked to DeepSeek taking a large amount of data using the OpenAI application program interface, or API. Earlier, the White House AI chief David Sachs told Fox News that there was evidence that DeepSeek had leaned on the output of OpenAI's models to help develop its own technology. Bloomberg has learned that Apple has been secretly working with SpaceX and T-Mobile to add support for the Starlink network in its latest iPhone software. In an under-the-radar move, the smartphone's latest software update released this week now supports the technology. The initial version of Starlink is exclusively for texting, but SpaceX and T-Mobile had previously said that they plan to expand into data connections and voice calls in the future. Now, John, you mentioned this at the start of the show. Shares of ASML are surging nearly 9%. That's the most since 2020. The Dutch company said that bookings in the fourth quarter were worth twice as much as analysts had expected, with the AI boom fueling demand for chip-making machines. ASML CEO also said that AI will bring more opportunities to the semi-industry. The company expects China sales to fall about 20% of total revenue this year. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. ASML absolutely crushed it. If you get similar performance later from Meta and Microsoft, we won't be talking about Monday for a long, long time. Absolutely amazing numbers from ASML.
Yeah, especially if you get the sense that they're actually monetizing AI. Of course, The details will be important in terms of that expenditure, the capital expenditure. Think about what happened to GM yesterday. They put up great numbers, and then people said, what about the tariffs? And then their stock tanked. So could you see something similar happen
How
here?
much weight can you put on the outlook when it's so dependent on what happens over the weekend? Up next on the programme, counting down to the tariff deadline.
The president has made it very clear, again, that he expects every nation around this world to cooperate with the repatriation of their citizens. The February 1st date for Canada and Mexico still holds.
That conversation just around the corner. We'll catch up with Annmarie in Washington, D.C. in just a moment. From New York City this morning, good morning. Equity futures on the S&P positive by about 0.1% on the S&P 500. In the bond market, some stability, 452.63. Lots of stuff going on. Earnings this afternoon, a Federal Reserve decision that people are barely talking about, Bramo. And then that trade deadline a little bit later. But the Federal Reserve, I do think is important to try and recognise, is this a skip or a pause? And I imagine Chairman Powell will be challenged on that matter.
How much is this just one moment on a path downward for rates? If this is a Fed that indicates they are done, or that there is a high likelihood of them being done with respect to further rate cuts, expect a pretty big move in the market that right now is sort of anticipating 1, 2, 3 rate cuts at a time, where some people are seeing the idea of disinflation continuing to take hold.
The focus this morning is get through the Fed and then focus on the earnings a little bit later, and let's see if we can get through the Fed quickly. Under surveillance this morning, we're counting you down to the tariff deadline.
February 1st date for Canada and Mexico. Also the China tariff that he has discussed. He rejected the 2.5% tariff. He said that was a little bit too low. He wants it to be higher. The president has made it very clear, again, that he expects every nation around this world to cooperate with the repatriation of their citizens. And the president has also put out specific statements in terms of Canada and Mexico when it comes to what he expects in terms of border security. The February 1st date for Canada and Mexico still holds.
So here's the latest this morning. The Saturday deadline fast approaching. President Trump preparing to slap Canada and Mexico with 25% tariffs, and still a consideration to put 10% tariffs on China. Part of the effort from the President of the United States to address illegal border crossings and the use of fentanyl. Annmarie joins us now from Washington for more. AMH, that deadline fast approaching. What's the latest?
Fast approaching, and the press secretary says it stands. So potentially on Saturday, we could see tariffs as high as 25% for both border countries, Mexico and Canada, and maybe even 10% when it comes to China. Or do we see something like we saw over the weekend, where Trump threatened all these sanctions and tariffs, said that they were in place, and then we saw moves very quickly by the Colombian government, and then he said those tariffs, those sanctions will now be on reserve. So I think the market has a lot to learn this weekend, how high those numbers are, how quickly they get enacted, and potentially are they going to be used as a negotiating tool to try to get especially Canada and Mexico to the table earlier to renegotiate USMCA. What exactly is he going to get after by coming out earlier on these tariffs? Because remember, his first day in office, he signed this executive order to have a memorandum to look into, to have a review on trade when it comes to America's trading partners worth billions of dollars. That date is for April 1st. So regardless of what we get on Saturday, I think we're going to learn a lot. One key thing is, of course, we know with tariffs, they can be enacted immediately. But in the past, we have seen governments give importers about a 90-day ramp-up period. So potentially, we are going to learn a lot depending on how these tariffs are enacted, what level they are, and if whether or not importers are going to get a leeway of 90 days.
We will learn a lot, and potentially not just on the U.S. side, but also what kind of retaliatory tariffs might be put into place by the likes of Canada and Mexico. What have we heard so far on that front?
Well, look, when it comes to Canada, they have this nuclear option, of course, when it comes to oil, because the United States imports that heavy crude, that viscous oil from Canada, and it's really hard to get from other places unless you want to say open up a lot more trading with places like Venezuela. That's not going to happen under this government. But that potentially what Trump is trying to do here is, remember when he first talked about tariffs when it came to Canada, we saw immediately Justin Trudeau fly to Palm Beach, go to Mar-a-Lago. Likely what will happen is this will lead to some sort of negotiation and potentially bring up those talks that are supposed to happen at the start of 2026 when it comes to USMCA.
Annmarie, also lots of questions about what a president can and cannot do. What's the latest on spending and giving a big exit ramp to a lot of federal workers as well? What's the latest on those 2 points?
Yeah, it's a great point because we had a judge last night block basically what they were doing in terms of a federal freeze. What the president was trying to do with the Office on Budget and Management was freeze a lot of federal spending, grants and loans, especially when they say it comes to ideological provisions, things like diversity, equity and inclusion. They did have to put out a memo after this because people were panicking and it did wreak a bit of havoc and remind people that, no, we want to make sure you still get maybe your student loans or Social Security or Medicare payments. So there's been a lot of confusion on this, but I think what you can take from this signal is that Donald Trump is acting like a CEO that wants to downsize the federal workforce. And we saw that again, offering buyouts for some federal employees, but they need to let them know within the next few days if they want to take it or not. They'll get a buyout if they want to leave their government job.
AMH, appreciate the update. Annmarie down in Washington. More from Annmarie a little bit later. Lisa, we were talking about this earlier this morning before we came on air, that we were basically seeing from Donald Trump, the president, a similar approach that we've seen from Elon Musk, the CEO, but this time to federal government and not to a private company.
Similar approach, I would say basically the same approach. In fact, the email sent to federal workers yesterday had the subject fork in the road. That is the same email subject that Elon Musk used in an email to Twitter, now X, when he was talking about downsizing the staff there. Can you do the same in a federal government? The courts will decide.
Julian Emanuel of Evercore is still with us. Julian, a lot to unpack here. Let's start with trade. Lisa mentioned GM. She's right to pick up on General Motors. GM's numbers weren't bad. The outlook was OK. Nothing wrong here. Stock was down by close to 9% at the close. How investable are some of these sectors, some of these stocks, without getting that clarity on trade?
Well, I mean, the share price reaction yesterday spoke for itself. But again, similar to how one is thinking about the share price reactions in the Mag 7, et cetera, on Monday to DeepSeek, these are the kinds of things that if you're a long-term investor, you know that whatever comes out in the beginning, whether it's 25% across the board or what have you, and we know that the automobile industry is going to be the most impacted if that kind of tack is taken towards Mexico, but that it is not likely to sustain itself infinitely. It sort of never has. And those are the kinds of times, particularly at valuations when you're talking about 4 and 5 times earnings, granted the earnings will be handicapped, but that's where long-term investors find value.
Just hold on a second. Are you saying that you bought GM yesterday?
I'm not saying
okay.
that.
I'm just wondering, is it too early, right? Is it basically this right now is noise and you can't really get involved in it, and at a certain point you can start to say, all right, now I can start picking up the pieces?
Well, again, it's a valuation sensitive thing. A lot of these companies, if you look at it, we like 5-year average valuations, okay? A lot of these companies are trading at substantial discounts to their 5-year average valuation. So I have a numerical advantage coming in that allows me to sort of ride out the volatility, even if it's multiple quarters, for that kind of, potential change in earnings.
Julian, certainly a volatile week, that's for sure, over the past few days. Julian Emanuel there of Evercore, with equity futures just about positive on the S&P 500. Bramo, I can't believe we're still not through January. This has felt like a lifetime, hasn't it?
Well, buckle up. We have 11 more months, right? And this is basically just the beginning. You're going to expect this, right? It's going to be shifting narratives, and it's just happening that much quicker. I just wonder who trades on all of the headlines, because they change day to day.
Well, someone has been. I will say this, on the East Coast, it feels like a grind getting through January, doesn't it? And then February. And then March.
Okay, I get it. You want the sun.
First quarter.
You want the sun. You want an earlier day.
I do.
I get it.
But at least in New York, you get the promise of that. I always say this. In the UK, you don't get the promise of a summer.
There's
so it's just that grind
attitude.
for the first quarter, the second quarter, and then summer never comes.
It will come. It'll be good.
From New York, this is Bloomberg. Decent bounce in yesterday's session. The bounce continues. We are up by 0.1%. Tons of earnings a little bit later after the closing bell. Before we get there, a decision from the Federal Reserve in the bond market. 2-year, 10-year, 30-year. Your yields look like this. A bond yield that's just about unchanged on a 10-year at 452.84. At the front end of the curve, the 2-year 419.29. And in foreign exchange, a tug of war between the ECB and the Federal Reserve over the next 24 hours. Euro-dollar down by 0.2%. Lisa, let's call this 104. Is it called a skip or a pause? In the Federal Reserve news conference a little bit later. And then for the ECB, do they just keep on cutting?
Or does it even matter what the Fed says or what the ECB says? And really, will it be at the White House? What type of tariffs get announced that will determine this currency pair? At a certain point, you want to think it's sort of a race to a bottom and maybe the ECB could win. But now they're both backing away from it. Meantime, I have to say, the dominating force has been tariff talk. And so I guess I can't really make any predictions right now.
Isn't there just a strong argument one way or the other to cut interest rates of the ECB compared to, say, the Federal Reserve?
You would think so, and yet recently there has been stickier inflation. And their one mandate is inflation. They don't have that dual mandate. And this is the reason why people are backing away for the potential to cut rates, even if, economically speaking, that might be the right thing to do.
It hasn't been great. When you speak to ECB officials, and I caught up with one last week, they'll make the point that we're still making our way back to neutral. Still not having a conversation about getting accommodative, and we'll see if that changes tomorrow morning.
Yeah, I mean, that's the key question. When do they start talking about growth and generating growth and not just kind of sticking to that idea of what is the numeral on the back of that 2%? That's problematic. Let's get that down.
ECB, just around the corner. The Federal Reserve up first. Under surveillance this morning, shares of ASML surging the most since 2020 after the company delivered better than expected results. Booking orders coming in at $7.4 billion in the fourth quarter, more than double what analysts had expected. That stock is higher by close to 10%.
To me, this is fascinating because it was a company that's been really hammered by some of the orders by the U.S. to not sell some of their advanced chip-making equipment to China. Can the U.S. take over that potential share? So far, the answer is yes, along with a whole host of other countries. But this is sort of the poster child that has been affected by some of the U.S.'s orders pre-Trump and how they're adapting going forward at a time where this very much is in demand.
So they got hammered on Monday. They were down by 7% at the close. Closed last Friday at 700. We're trading at 705 right now. So it's like DeepSeek never happened. Earnings matter. And let's see if we get a reminder again a little bit later this afternoon.
People have also reassessed how much chip makers will get hit if there is some sort of greater efficiency, because if you have greater adoption, you'll have greater uses of chips. It's not the chips that have gotten most hammered and that hammering has stuck. It is the power generators and some of these other areas. So that's been the takeaway over the past 2 days of whipsaw.
Didn't see a convincing bounce. EQT, Constellation Energy, Kinder Morgan, pipeline operator, all those things. I was looking at the same thing yesterday. Didn't see a convincing bounce through the session.
And Tom Kennedy of JP Morgan Private Bank yesterday, he indicated this was the one area that they're rethinking as a result of some of the efficiency, not necessarily the chip makers, not necessarily some of the big tech players. And that's what we saw play out in the equity market yesterday.
ASML right now positive by 9%. Elsewhere, a federal judge temporarily blocking the Trump administration from enforcing a new directive to hold trillions of dollars in federal spending. This coming as President Trump is offering buyouts to federal employees who won't comply with his demands that they return to the office. This could have big economic consequences.
And constitutional ones, too. And this is what I think might be the design, that actually this is a president that wants to establish constitutional precedent ahead of making some big changes. I was looking back to the 1970s, where President Nixon came out with a whole host of different campaign issues and different budgetary issues that he passed. And as a result, Congress passed something basically saying, no, we have the power of the purse, not you. This challenges that. And this is something that Donald Trump has said he wants to challenge. And if this gets through and he has that authority, you can imagine he will implement a lot more sweeping changes to come.
And then there's a new wrinkle in the Federal Reserve's outlook. The Federal Reserve decision coming at 2 p.m. Eastern Time. 30 minutes later, a news conference with Chairman Powell. The central bank widely expected to hold interest rates steady, giving themselves more time to lower inflation and assess the impact of President Trump's policies. We are very, very policy dependent at the Federal Reserve. And by policy dependent, I mean White House policy dependent on the FOMC.
And each Fed member has a very different take on exactly how those policies have the potential to reverberate through the economy. Chris Waller, remember, coming out and basically saying that a lot of these tariffs will be disinflationary, if anything, and that they do nothing to really interfere with the ongoing trend downward. At the same time, you have others that feel differently. So Where does Fed Chair Powell stand, and how much does he want to ignite the fury of the White House?
Hopefully we find out in the news conference a little bit later, but I'm with you. We are going to get a live blog at some point, aren't we, from the White House on Federal Reserve decisions?
If we don't, I think a lot of people would be very surprised, given the fact that this is Donald Trump who came out and actually said he knows interest rates better than Jay Powell. He thinks they need to be lower, much lower, and let's go. So there is this feeling that he is going to continue to job out on the
To be honest, at this point, I'd be disappointed if we didn't hear from the
I think a lot of people
president a little bit later this afternoon. Let's turn to commodities. Gold rebounding from its Monday drop amid uncertainty over President Trump's proposed tariffs and ahead of today's Fed decision, now roughly $30 shy of its all-time high. Michael Widmer of Bank of America follows the metals closely. He joins us now for more. Michael, it's good to see you.
Good morning.
Let's start with Monday. What did we learn about the relationship between risk assets, equities and the like, and gold?
There is not always a clear relationship. I think that's what I would say. I think generally when I look at what happened on Monday and kind of the volatility that we had on the equity side, look, gold has just been very resilient. And I think we've actually stuck to our $3,000 pounds price target for this year, because everything that you've just said, there is a lot of tension in the system, in the markets at the moment, generally, with the uncertainty about Trump, the uncertainty about the relationship with the Fed, and ultimately that's one of the factors that should attract investors to the gold market.
You believe it still has defensive properties, risk mitigation characteristics, even with Monday's move?
It does, but I think there is a more structural element to it. It's not just, look, equities go down, therefore you have to look for a safe haven asset. I think when you're looking at the global macroeconomic environment, I think that tension potentially between, well, the Fed should keep rates high, Trump wants to have them lower, is one of the things I think that causes a lot of apprehension. When you are like a non-US central bank and you hold a lot of your assets in US dollars and US treasuries, and you see the tensions that coming up, say, on the fiscal side in the US at the moment, deficits at 6 to 7%, with risk of increased volatility on that front as well. Do you really want to keep a very large share of your holdings in treasuries? Look at China last year. Total FX holdings declined. Gold holdings actually increased. And that is a good guidance on how popular gold actually in the current macroeconomic environment still is with some of the central banks.
Gold tends to be a haven asset, as John was mentioning, and tends to get bid up when economic activity goes down. At the same time, there are a lot of people getting increasingly bullish on a lot of industrial metals that typically do better when economic activity goes up. How much is that just simply a tariff play, and how much is that something that really does speak to the expected build out of the real economy, of the real kind of asset world?
You mean on the industrial metals specifically? Look, I think there's two parts to that. The first is the supply side. We have genuinely underinvested in the industrial metals on the supply side for the past 10 years. Miners generally tightened their belt. I think there was a bit of a misallocation of capital during that time. And what you have now is kind of that push for the energy transition, a structural trend. China's grid spending carried the global copper market for the last 2 years. Now you have got the US and Europe coming in, and you just don't really have the tons available. So you have got this kind of cyclical metals becoming more of a structural play where demand just keeps trending higher and keeping the market relatively tight. And of course, on top of all of that, you have potentially for bottoming out in global growth as well at some stage. That adds then to the upside too.
Just to underscore what you're saying, is the U.S. taking over where China once lived when it came to demand for some of these industrial metals?
U.S. has exported a lot of its metals demand, offshored a lot of the metals demand to China. So on the copper market, the U.S. is 10% of copper demand, of global copper demand. China is 50%. But what we are seeing right now is that the U.S. is trying to get some of that metals demand back into the U.S. by actually rebuilding some of the domestic supply chain. So the U.S. is not necessarily picking up of where China left it off. China is still quite strong, but the U.S. becomes an additional factor where you can actually see, rather than like a decline in demand, which we've seen during the last 20 years, the demand is actually starting to come back and increase and adds to some of that tightness.
We do have potential supply in the United States of America. I think it's the resolution mine in copper that Rio has the opportunity of really running and meeting 25% of annual copper demand of the United States. Do you see them making a move on the supply side story with this administration?
I think we're talking also about tariffs on copper in the last few days from President Trump to actually rebuild the supply chain. So there's certainly an awareness that you would like to increase domestic supply, but particularly when you're looking at resolution copper, there's a handful of mines actually in the US that with all the best intentions, didn't make it to the market because you have, for instance, local resistance to those operations. Permitting has been quite difficult for those. So you also need to change, I think, the operating environment, helping the miners to actually bring those mines to the market. Rio Tinto said recently that they're actually quite optimistic now in getting that mine through.
How much would that change things if things like that came online?
It would help, I think, because we have got a relatively empty global project pipeline. So we need literally every single project that we see right now coming on to prevent rising deficits in the copper market. It wouldn't necessarily change the underlying dynamics. We would still have shortfalls on the copper market.
In the meantime, it's not just with respect to a shortfall in supply, it also has the potential for tariffs. And Trump was speaking in Miami recently and said, I'll be placing tariffs on steel, aluminum, and copper and things that we need for our military. How much do you expect that to end up really adding an additional boost to pricing going forward?
No, look, it's one of those sectors. I think we just have assumed that the metals is available as we need it. And defense spending is now starting to pick up, as is energy transition spending in a lot of countries. And we just turbocharging metals demand growth. In an environment where already now, just at the start of that happening, we know that we don't have enough metals available. Look, copper last year, when I look at global PMI, it should have traded a third lower where it was, but it was just very resilient. When you're looking at all the macro issues that we have thrown at the copper market, I could have in the past easily justified a bear market. And now all of that spending that you've just said is basically coming through, and that just adds a lot to the tightness in the copper market.
When you put it all together, there was 10 years of a bull market where all of the metals that you covered did really well. Then there was 10 years of death where basically it bottomed out and there was a real rethinking of how important metals were to the physical worlds that no longer seemed to depend on things that were physical. Are we now entering a new bull market for the metals that you cover?
I think starting with public awareness, yes, I think there is certainly much more awareness now that you need those metals to run your economy. And I think governments, with all the push on the AI side, for instance, realize that you can't build electricity networks, power and data centers without having access to some of those metals. So I think what comes first is the demand will go up, and then with a lag, potentially you get more supply into the market. And that's exactly what is driving the tightness or the support to the prices that we see at the moment.
Michael, enjoyed this. 3K target on gold, 3,000, right?
Yes.
Year end. Appreciate it. Thank you, sir. Michael Widmer there of Bank of America on the metals market. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Trump has invited Israeli Prime Minister Benjamin Netanyahu to a meeting at the White House next Tuesday. The early sit-down, confirmed by the Prime Minister's office, comes just weeks before the end of the first phase of the pause in fighting in Gaza. Starbucks reported better than expected first quarter earnings. Same stores sales fell 4% compared to a 7% slump in the prior quarter. Its new CEO, Brian Nicolai, is focusing on improving the store experience. This week, Starbucks brought back ceramic mugs and the condiment bar. It also plans to cut 30% of its food and drink lineup to simplify the menu and speed up service. Novo Nordisk's popular weight loss drug Ozempic has been approved by the FDA to treat chronic kidney disease in patients with type 2 diabetes. Studies have shown that Ozempic can reduce the risk of death in patients with kidney disease caused by diabetes. Novo Nordisk gaining just under 1% in the Denmark trade. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, earnings from the Mag 7.
It'll be very interesting to see what the earnings reports are going to be like this week. Magnificent Seven are magnificent for a reason. Does this mean that there are other companies in other countries that will compete and challenge that dominance? Sure, but that world existed last Friday as well.
Numbers from Microsoft, from Meta and Tesla, all coming up a little bit later on this afternoon. From New York, this is Bloomberg. Equities on the S&P positive here by 0.1%. Lots of earnings a little bit later, and a Federal Reserve decision in the bond market. Yields going nowhere. The 10-year 453.24. Under surveillance this morning, earnings from the Mag 7.
It'll be very interesting to see what the earnings reports are going to be like this week. I don't think the U.S. exceptionalism story was built just on ChatGPT. I mean, I think it's built on this idea that, A, we are the greatest innovator in the world. Magnificent Seven are magnificent for a reason. One of them owns social media. The other one owns smartphones. The other one, I mean, you can keep on going down the list. So, yes, does this mean that there are other companies in other countries that will compete and challenge that dominance? Sure, but that world existed last Friday as well.
So here's the latest this morning. Microsoft, Meta, Tesla kicking off Mag 7 earnings after the closing bout. The results coming as China's DeepSeek AI prompts concerns about US tech valuations and competition. Ahmed Khan of Morningstar has a hold rating on Meta and a $5.90 price target. He'll be looking for information on AI monetization, content moderation changes and possible job cuts on the company's call later on this afternoon. Ahmed joins us now for more. Ahmed, welcome to the programme, sir. It's good to get your thoughts on the programme, and I want your thoughts on Monday before we get into the earnings a little bit later. Something interesting happened. Meta closed the day positive. Microsoft did not. What's the best way of explaining the difference between the two?
First of all, good morning. Thanks so much for having me here. The way we think about it is that a lot of investors obviously got worried about what that means for some of the Gen AI investments, especially as it relates to CapEx. Going forward, whether that CapEx is a good sort of use of capital. Now, where Meta, we think investors had a nuanced view, was that with AI or LLM prices going down, you would see Meta benefiting from using that sort of generative AI throughout its advertising products. So I think that was the nuance that was built in with Google and Microsoft being down, but Meta being slightly up that day.
For Meta specifically, Ahmed, with that in mind, is it easier or harder to justify the CapEx spend that they unveiled last week?
It is certainly interesting, right? I think the way we think about Meta and Google and Microsoft and Amazon is that you have this commodification of complements, right? So we think of generative AI or LLMs and Meta's advertising product, for example, or advertising sales as complementary products. As the price of generative AI goes down, that means Meta can actually use generative AI to create better content creation tools, create better content creation recommendation tools, and obviously monetize, have better monetization on their ads as well. So the value of the ads product goes up. Now, you could make similar arguments for Microsoft and Google as well. They obviously have a variety of different products that would be complementary to Gen AI as well. But that's the way we think about sort of Meta's Gen AI play, and we think of it as a smart decision.
I mean, there are a lot of issues that are facing Meta that have nothing to do with exactly anything in their control, including what happens with TikTok. And I wonder if you're expecting any kind of commentary today about whether Meta could potentially bid for it, what the potential exit of TikTok from the market would do, and how they're preparing to try to gain market share, as there are questions swirling over that platform.
First of all, I would just like to say that it's highly unlikely that Meta would be allowed to bid for TikTok just because of antitrust concerns. I know the antitrust environment is going to be different under a new administration, but still, if you think about Meta's dominance of social media, I think it's going to be tough for them to bid for it. In terms of Meta actually gaining market share, if TikTok was to go away, we actually have good data for that, right? So you had India that banned TikTok back in 2020, and after India banned TikTok, you actually saw sustained increased engagement for both Meta's Instagram and YouTube Shorts, which are the two sort of complement or substitutes, rather, for TikTok. Similarly, when Meta had an actual outage, when all of their applications went down, during that time, you saw TikTok and YouTube usage actually increase, again, showing that sort of substitution effect. So certainly, if TikTok is banned in the US, we would see Instagram, which is obviously owned by Meta, to be the biggest beneficiary. But our base case does not include TikTok being banned.
There are reports this morning that Mark Zuckerberg is looking at properties in Washington, D.C. He already has a property in mind. The idea here is to get closer to the president. We saw him at the inauguration. He has been someone who has a constant presence down in Mar-a-Lago. As an analyst, how much does that actually influence your view of the company, as essentially a greater leg up with this administration could potentially be beneficial to the company, as we have seen with Elon Musk?
I would just like to say that, companies' lobbying efforts are nothing new. We've seen this in tech before. So that's just the first thing I would say. The second thing, obviously, we wrote a piece on the effect of the elections, especially as it relates to big tech. And we had the view that a Republican sweep would actually be beneficial to big tech, not because we were expecting all these big tech companies to actually get closer to the new administration, but rather, some of the antitrust headwinds would moderate, some of the regulatory headwinds would moderate, and we see that effect going forward as well.
Ahmed, appreciate your time, sir, as always, and your input going into numbers a little bit later on this afternoon. Ahmed Khan there of Morningstar, ahead of numbers from Meta and Microsoft. There's nothing new about this. There's one thing new about this: the party's changed. These companies have been cloaking themselves in liberal values for years and years and years to insulate themselves from the regulatory impulse of the left, and now they realise they've got to do something similar on the right.
It has been a pretty big about-face, and we have seen that pretty dramatically. What I'm curious about, particularly with the Elon Musk effect, is that it has basically put a spotlight on this dynamic in a new way, just based on even the stock valuations and some of the regulatory structure for automated cars, right, for automated driving. So you just wonder, is there an extra lever that you can pull if you are closer and have the ear of the president in terms of deregulating certain sectors and moving toward other things? I mean, this has always been true. It just is a lot more transparent, perhaps, this time around.
Do you think so? I think it was transparent last time around.
It's much more, well, really, the same kind of public sort of...
So billionaires making big donations to the Democratic Party repeatedly.
Big donations is different than going down and, basically trying to create that connection with the person and talk about how wonderful they are. We don't see that usually. Do you hear that from the big executives where people would come out and say Biden is the best president that we could potentially have?
Well, no one would go that far.
Well, I'm just saying.
They've seen him over the last 12 months.
Okay,
I'm not sure they could get him on the phone.
I'm just saying, it seems like there's a shift in tone. You could say it's business as usual. And frankly, what Ahmed was talking about is that their assessment was that Trump administration, actually a red sweep, would be better for big tech because of the regulatory types of constraints that would be removed.
We'll see what kind of changes we actually get and who it benefits, right? And let's be consistent about asking these questions. This is not aimed at you. The complaints that I've heard from Senator Warren, what is it you want? What is it that you want? I didn't see those complaints over the last 10 years when the money was going in the other direction.
It's fair. And honestly, I think that this is an important thing to keep calling out, that where is the consistency in some of the complaints with respect to media, with respect to dominance in certain areas. You're right. I think it's very hard to get consistency. I mean, whether it comes to the idea of TikTok and what to do with that, or whether it goes to this question of whether big tech firms are too big. I mean, these are all fungible issues that have bipartisan support on both sides. We're used to.
Got to call balls and strikes. Do you see how hostile the press pack were in the briefing room yesterday? Didn't see much of that over the previous 4 years, did we?
It's a new regime, and there's been a real challenge to legacy media over the past couple of days.
And that challenge gets greater, that's for sure. Equity futures on the S&P positive by 0.1%. Up next on the programme, Lisa Shalett of Morgan Stanley, Nicolai Tangen of the Norwegian Wealth Fund, the former senior White House trade advisor Kellyanne Shaw, and the former Kansas City Fed President Esther George. The second hour of Bloomberg Surveillance is up next.
The underlying sort of impulse of the economy has been for this gradual disinflation, but inflation is still sticky.
What we have is a very imbalanced economy, and the labor markets are still cooling.
I think what the Fed is signaling on Wednesday is super important for the rest of the year.
I'm not expecting much from this meeting just because there's so much in flux.
The Fed has got to get more strategic in its approach and has got to stop being excessively data dependent.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now. Let's kick it off with the scores. Equity futures positive by 0.1% on the Nasdaq 100, higher by 0.4. Big afternoon coming up for the Nasdaq. We'll get numbers from Microsoft, numbers from Tesla, numbers from Meta. Before we get there, we've got a Federal Reserve decision just around the corner as well at 2 p.m. Eastern Time, followed by a news conference with Chairman Powell at 2:30.
This is the dark horse event, the one that people are not looking forward to, that think that it's going to be incredibly boring and that essentially he'll say nothing and then we can all move on to Meta and Microsoft and Tesla earnings. But to me, this has possibly one of the more disruptive potentials, given the fact that if there is an indication by Fed Chair Jay Powell that they might not cut rates at all for the remainder of this year, that would be a massive risk-off event for the entire market.
Skip or pause, and how much weight can you put on the forward guidance? And this is something that we were talking about earlier with regards to a company you brought up, General Motors. How much weight can you put on the outlook, given how trade-dependent that outlook might be? And we might get some new information on trade over the weekend. Do you really want to get out in front of that if you're Chairman Powell?
For General Motors, it was an issue of they had everything that looked pretty good, beating expectations, and yet they are potentially the most susceptible to tariffs, particularly on Mexico, that could come into play as soon as February. Do tariffs have the same kind of economic ramification more broadly that the Fed has to take into consideration? That, I think, is the key question, and we've heard Chris Waller's take on this, which is not really. And I guess that, to me, if you do hear from Fed Chair Jay Powell that they could have similar broad-based ramifications for the overall economy, that would also be a potential market-moving event.
We don't assume, we don't guess, we don't speculate, but we kind of do. That's what we learned in December. Some of us do. Let's see if they assume, guess, and speculate a little bit later on this afternoon. Coming up this hour, we will assume, guess and speculate. We'll catch up with Lisa Shalett of Morgan Stanley as investors await the Fed decision. Nicolai Tangen of the Deutsche Bank weighing in on US tech dominance, and former senior White House trade advisor to Trump, Kellyanne Shaw. We begin this hour with stocks higher, investors catching their breath before the first Fed decision of 2025 and big tech earnings this afternoon. Lisa Shalett of Morgan Stanley saying the surge in long-term bond yields has created a headwind for US equities, which have ridden valuation expansion for the better part of 27 months. The market narrative is now focused on show me earnings achievement. Lisa joins us now for more. Lisa, good morning.
Good morning.
Got some earnings achievement over in Europe. ASML, just absolutely stunning. And we saw how stock investors rewarded them.
Yes.
What would you look for from some of the big tech players, not just this afternoon, but over the next week?
So, look, I think obviously, tech is under the spotlight, not just given the fact that their performance has been somewhat really lackluster since the first week in December. But the expectation for 2025 and 2026 is that earnings growth rates are going to decelerate, right? And that element has been math, and that's what's kind of baked in. And so I think people are looking for that guidance more than what they do for the fourth quarter, but looking for that guidance to see, are in fact tech companies more measured or are they more optimistic? And I think that's that guidance, forward guidance, that's really going to carry the day here because, coming into 2025, 2026, for tech companies, I think some of the expectations were a little bit more realistic.
Does it get harder to justify the big spending they've been doing following the news of the last week and the price action of Monday?
Certainly, it raises the question on what is your CapEx efficiency, right? Do you really need to spend, as much CapEx and build as many data centers with as many GPUs that use as many NVIDIA chips? Are you going to be able to, through process and software engineering, as we've seen, do things, cheaper and faster, especially if you're willing to use an open source chassis? And I think that these open source chassis are going to get more and more and more sophisticated, and they're free. And that's I think, the magic here. That we're going to have to watch. And look, I don't think that this is new news to Sam Altman or to the folks at Microsoft and Google, but I do think they're going to now have to talk about it.
Earnings season used to be launched by the big banks, and it seems as if now that's shifted. It really is the tech players, and there is a broader economic read-through depending on what happens there. We've been talking a lot about whether we are reaching the tipping point at which investment in AI is moving away from the chips and the data centers into broader application. What would you have to hear at today's earnings reports to think this is truly that tipping point?
I think it's them not taking up the guidance on CapEx. I think it's them answering the questions, hey, we've put the number out there at X, that's our number. right? And being somewhat combative with analysts on that. I think that would scare people if they suggest that there's no incremental upside to their CapEx spend.
As an investor, does that make you more optimistic about the rest of the universe that could potentially benefit from AI adoption?
Yeah, so that's, to me, I think the great question, Lisa, right? So I think that there's two things. I think there's one, among the Mag 7 themselves, who are going to be the ones who actually grab onto this and say, you know what, we've actually been studying this. We do think we're going to be able to be more effective, more efficient, and spend 20% less. And then there's going to be the folks who are the adopters, right, who are apps guys, who are actually developing tools that are using, agent AI, the Salesforces of the world, the Accentures of the world, who are that next wave of companies who are going to say, hey, we're using these tools, we're driving efficiencies and effectiveness, we know how to do this, and that they're the next market leaders in this, tech diffusion cycle.
Is it too early to jump on that theme, or do you think the starting gun was fired on Monday?
I think the starting gun on it was probably fired in the fourth quarter of last year. If you look at those stocks, they've started to move. But for them, we still think it's kind of bottom of the first inning, top of the second.
When do we start to see the big efficiency gains in sectors like the financials? We've been hearing about this now for years when it comes to the banks.
Yeah.
The banks could benefit big time. You could see them become really efficient. We hear from the CEOs, each additional dollar revenue will become less and less labor intensive. Are we close to that?
So I want to define close, right? Look, I think a lot of effort is being expended, a lot of money, a lot of consulting dollars are being expended here. I still think that in terms of moving the needle on margins, you're still probably 2 to 3 years away from seeing, companies truly be able to say, we're hiring many fewer people, our productivity has gone up by, X, Y, or Z. Because it's most of these businesses, the stakes of getting it wrong are so high that before you really start pulling people out and relying on machines to do your, client service or your customer interaction or your billing or whatever, you're going to have to know that it works.
This is all very nuanced, and a lot of your clients are probably thinking, all right, our market's going to go up or down.
I know.
And what do we have to look at to figure out where we should invest? And if there is some sort of macro theme, it really does come down to the yield space. This idea that you see some of these stories as potentially constructive, earnings growth is potentially positive, and yet it all hinges on what happens today with Fed Chair Jay Powell, not necessarily today, but just generally with the bond market. Can you talk about that relationship?
Sure. I mean, look, I think what we've seen is, the magic number's been 4.5%. When we get yields through 4.5% on the 10-year, we've seen those positive correlations between yields and stock prices. The quote that Jonathan started with, that starts becoming a headwind to valuations. Now, why is 4.5% such a magic number, right? I constantly explain to people, look, we've been in an economy that's been nominally growing at more than 5% per year. And as long as you're growing faster than your cost of capital, you're going to be able to cover your interest payments, right? As those interest rates get closer and closer to that nominal growth rate of 5%, that ability to cover interest payments gets harder. You start thinking, well, are some of these companies actually going to have dented margins because their cost of capital may actually be 6 and maybe, GDP is only 5. And so, we're watching the direction of the long end. What we have observed is that a lot of the movement on the long end has been driven by two things, not inflation expectations, actually by our analytics. What we're looking at is we've had positive economic growth surprises, right? So that's taken up the real component. And we've had an increase in the term premium. And as I know having kind of, studied fixed income for a really long time, over the last, 80 years, term premiums on the long end have been as wide as 150 basis points. Term premiums, for your listeners who may not know this, are basically just the extra risk premium that investors demand for policy uncertainty, right? For the fact that over time, things change. Anything from policy to technology to et cetera. And so, I think what we're looking at is, what are the drivers of those interest rates? What has been interesting is Fed expectations got crushed in the fourth quarter. So for us, our observation of what's happened over the last, 6-8 weeks is it hasn't been that much about the Fed. So this is a very long-winded way of me answering your question. Look, I think Powell today is going to be very measured. I think he's going to say very little in this press conference, and I think he's going to try to say as little as possible about anything that has to do with the White House. Anything about tariffs, anything about debts and deficits. I think he's going to really walk a very fine line, and he's going to stick to the script of we're data-driven, that's it, we've had some stronger data, we think inflation's under control, we're watching and waiting.
So all of that said, if the Fed is no longer in the driver's seat, the policy uncertainty is in the driver's seat. Yeah. What kind of move up, we're looking at a 10-year right now at 4.53%, what kind of move up would you have to see real serious declines in equities?
I think if we surge back through 475, sometime over the next month, that just stops stocks in their tracks again.
Just 22 basis points away. Lisa, it's good to see you.
It's great to see you.
Lisa Shalett there of Morgan Stanley on the Federal Reserve. This one apparently is easier, relatively speaking, and I would say because they don't have to put out forecasts. And Lisa, it gets harder on March 19th when they meet again because they have to put out forecasts.
And they have more sort of room to discuss these policies. They'll have actually come into effect or will have seen some of the agenda in the first 100 days. So suddenly it becomes much more difficult to just say we don't assume. We don't speculate because you don't have to speculate and assume. You can see what the proposals are. You can see the potential ramifications start to trickle in.
Or by the time we get to March, it's still a threat, just sort of hanging out there.
If that's the
case,
might be. If that's the case, that also would be interesting because that will have economic effects with people bringing forward orders and potentially ratcheting down some of their supply chains. That would be interesting as well.
A mini stimulus. We talked about this yesterday. Federal Reserve decision coming up a little bit later on this afternoon. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Trump is offering buyouts to federal agency employees who don't want to return to the office. The buyouts were offered in an email, which also warned that the administration is seeking a, quote, more streamlined and flexible workforce. The National Treasury Employees Union says that the email was designed to scare staff into quitting. Chinese tech giant Alibaba has released a new version of its AI model. The company is claiming that its model outperforms OpenAI, Microsoft, and DeepSeek. Alibaba is engaged in a hot contest to recruit China's AI developers to use its tools. It slashed prices in recent months to win over even more users. LVMH shares are sliding 4.8% in the Paris trade. The luxury house's fashion and leather goods sales declined 1% in the fourth quarter, casting doubts on a quick recovery in luxury. Despite the declines, Tiffany's sales were up, and Louis Vuitton had a strong start this year with double-digit growth. CEO Bernard Arnault said that he predicts a booming U.S. market. And that's your brief, John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the programme, tech earnings on tap.
What causes U.S. exceptionalism? It is tech innovation. We have the highest earning companies in America. These big tech names, though, are not an obvious loser to me. The top 5 names, they have access to the software and the interaction with their clients, so volume can actually sustain them.
In just a moment, we'll catch up with Nicolai Tangen, the CEO of the Norwegian Sovereign Wealth Fund, on U.S. dominance and tech concentration. That conversation just around the corner. Live from New York City this morning. Good morning. Here's a snapshot of the price action right now. Equity futures just about positive by 0.1%. Big afternoon coming up. We'll hear from the Federal Reserve and Chairman Powell. That news conference is at 2:30. The decision at 2 p.m. And then we get some big earnings later from Microsoft, Meta and Tesla. Under surveillance this morning, tech earnings on tap.
What causes U.S. exceptionalism? It is tech innovation. We have the highest earning companies in America. Our preferred sectors are still tech, industrials, utilities. So we still like those sectors, again, at a price, and you just got a better price. These big tech names, though, are not an obvious loser to me. The big tech hyperscalers, your top 5 names, they have access to the software and the interaction with their clients, so volume can actually sustain them.
So here's the latest this morning. Meta, Microsoft and Tesla all reporting after the closing bell. Elsewhere, tech stocks fueling a 13% total return for Norway Bank Investment Management in 2024. But the fund missing the self-imposed target for a second year in a row. Joining us now, I'm pleased to say, the CEO of Norway Sovereign Wealth Fund and a good friend of this programme over the year, Nicolai Tangen. Nicolai, welcome to the programme, sir. I wanted to kick it off with concentration risk, particularly in the United States, and how you perceive things at the moment, particularly given what we saw in Monday's price action. Is this heavy tech weighting in global equities a desired feature or a bug from your standpoint?
Oh, I think this consists, of course, of really fantastic companies, so it's absolutely a great feature. And we have big gains from these companies. These are, many of our very large holdings in the fund.
One thing you said last week is that maybe the contrarian investor might consider pulling back from the United States and leaning into China. Those comments timely, given the events of Monday. How are you actively positioning around that theme, if at all, into 25?
No, we are not positioned around that theme. We just talked about what is the contrarian thing to do. And of course, the contrarian thing to do is to reduce U.S. tech exposure. I'm not saying it's the sensible thing to do, and it may be way too early, even though on Monday it certainly seemed pretty clever.
Is it the prudent thing to do? If it's the contrarian thing to do, can you tell me whether you think it's the prudent thing to do, to maybe rebalance some of that exposure to elsewhere?
It's a very, very difficult question. But the thing is that very many of these large tech companies, it's the same driver. It's the same geopolitical risk, is the same world hotspot. And so if you get correction in one of them, you certainly can see, very much of your portfolio coming down at the same time, because now we are seeing the top 10 companies in our index is basically accounting for 20% of the market.
Nicolai, are you adjusting any of your diversification after last year's missing of the benchmark to be more concentrated, since that's where the gains have been?
No, we are not. We are a very long-term investor. We are widely diversified across the world. We own, part of 9,000 companies, 1.5% of all the equities in the world, and so we continue to be diversified in that way.
How much are you thinking about real estate as a potential holding, or just real assets in general, since they were an underperforming part of your portfolio? Do you still see them as potentially being a good diversifier at a time where some people are talking about structurally higher benchmark yields?
Well, we think real estate now is becoming increasingly interesting, and so we've been pretty quiet in the real estate market over the last few years, but over the last 3 to 6 months, we've added to our exposure, and actually both in real estate, but also in renewable infrastructure assets.
Is there a particular location that you're interested in? Let's start with real estate, where you've been really expanding some of your footprint.
Well, just over the last couple of months, we've been expanding in London and some of the main cities in the US.
Nicolai, I would love your thoughts on the new Trump administration as well. You've experienced this before. There's always uncertainty around policy. Do you have a base case on the changes you're expecting this year?
Yeah, you know what? We are a non-political entity. We don't have, we really don't have a view on politics generally. So it's a bit tough for me to answer that.
I don't expect you to take a view on politics, just policy. Do you expect trade changes? Do you expect changes around the fiscal deficit? Do you think they can cut that back? Do you expect it to be increased because of the tax cuts they might expend? Just your assumptions on policy. Forget the politics.
Okay. So what we are seeing as a global investor, we are seeing that some of the climate initiatives are being rolled back. Now, we think climate risk is a financial risk. We do see tariffs, which are hitting some of our European companies. We are seeing a bit more risk for inflation. But at the same time, when we speak to US CEOs, they are very, very optimistic about the outlook. So, positive backdrop for the US companies.
You said that there's still a risk of inflation. And I know that you've warned about the deficit and how much it's been increasing. And I just wonder how that's colored your view on bonds as a diversifier at a time when potentially, if yields stay where they are or even go up, they don't offer that same sort of hedge that they have in the past.
No, I think that's correct. And it's very, very difficult to know what's going to happen with the long end of the yield curve, because if you do get significant inflation, you could suddenly have a moment where investors say, "Listen, we want to have a higher coupon to finance the government debt." Now, that's not only in the US; that's in many places in the world. I think it's IMF who says that there is a combined world government debt of $100 trillion. And so these are very significant numbers.
How has that colored the view of how you want to allocate some of your assets? At one time, it was thought that maybe equity allocations should come down in favor of private markets or real assets, and that bonds would stay the same. Is that changing? Or suddenly bonds become as much of a risk in some ways as equities?
No, I just think it's a case for being, very broadly diversified and taking an even longer term look at what you're doing than before. I think that's really the case.
Nicolai, just a final question. I'd love your thoughts on this. Given the price action we saw on Monday around the innovation of DeepSeek, as you sat there with the team, did you believe some of the claims that were being made, that this was somehow export compliant with regards to the chips that they were using, that they managed to develop this for around $5 million? Do you and the team believe that?
Well, I think there are cleverer people than me who can make that judgment. But what we do observe is when we speak to CEOs across the world, the innovation power of China is just really tremendous. We see it in batteries, electrical vehicles. We see it in pharma. We see it in mobile phones. We just see it across the board. Very, very strong innovation power. So I think that's the lesson to draw from that.
Because, Nicolai, as you know, whether you believe in that or not would go some way to whether you decide to push back against some of the big capex decisions of the big tech players, particularly those located in the United States. Do you think those big outlays of cash make sense?
I haven't got a strong view on that, but what I do think is that cheaper models will lead to a better democratization of artificial intelligence, and that's generally good for the world. Interestingly, we did a survey in our company just before Christmas, and we asked our colleagues, how much have you improved your efficiency over the last 12 months on the back of these new tools? And the average was 15%, 15% in our company. So these are huge gains.
It's happening. That's for sure. Nicolai, I appreciate your time. As always, thank you, sir. Nicolai Tangen there of Deutsche Bank Investment Management on US tech concentration, dominance, and some of the innovation we're seeing coming out of China over the past week.
Yeah, given the fact that it could potentially be the tipping point for people to really understand the adoption. That last point was really interesting, that each of his own staff had increased their efficiency by 15%. How do you quantify that? This is already happening, but how do companies quantify this at a time where you are seeing adoption? It just is sort of stealth.
I watched Mike Wilson's interview with us from Morgan Stanley a number of months ago, and Mike was talking about this, the shift from enablers towards adopters, and how close were we to making that shift? And it looks like we're closer after what took place on Monday.
It might be already happening. It's just that there hasn't been this aha moment, sort of like ChatGPT wasn't the first time that a large language model had ever been used in this capacity, but it was the aha moment. What will that aha moment be where people understand the degree of efficiency that some of these tools already are having in different companies?
Equities on the S&P, just about positive on the S&P 500, going into a big afternoon. Up next on this programme, the former senior White House trade advisor to President Trump's first administration. We'll catch up with Kellyanne Shaw in Washington. From New York City, you're watching Bloomberg TV. Two hours away from the opening bell, equity futures on the S&P just about unchanged. On the Nasdaq, still positive by, let's call it 0.4%. With some morning movers, let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, good morning. 29 days into the year of 2025, and the question is it evolution or revolution when it comes to AI? Alibaba don't want to be left out. Here we go, up 3.74%. They've delivered a new update to, guess what, their AI product, Qwen 2.5 Max. So this is about standing shoulder to shoulder with American AI. Now, the question is it China versus America, or is it open source versus closed source? Those are the kind of debates that we're going to have. BI have now said the question for them here is the monetization challenges are still there because there's cutthroat competition in China relative perhaps to the monetization proposition here in the United States of America. So that's the Alibaba story. ASML. They lost 19 billion euros in market cap on Monday. We have this bounce back by 7.5%. The order book is swelling, over 7 billion euros, double the estimate. And they're talking about the guidance. By the way, this stock dropped the most in 26 years in the autumn time because they cut the guidance for this year. Right now, they're saying we see the opportunity towards the highest part of the full year guidance. So it's about raising the expectations again. Emergence of DeepSeek is good news, and their reliance on China will drop from 25% down to 20%, I think partly due to regulation and demand. And then when it comes to superlatives, you got to hand it to the CEO over at T-Mobile. A monster fourth quarter. I love that. Who wrote that? The PR that wrote that for him. Smashing all expectations, $2.57, up 54% year on year. They added over 900,000 post-paid, and they have had the best start of the year in terms of the guidance ever. Superlatives, hey? Jonathan.
Love it. Thanks, man. A stock up nicely by 8.5% in the pre-market. Under surveillance this morning, Microsoft and OpenAI are investigating whether DeepSeek accessed unauthorized data from OpenAI. Sources telling us here at Bloomberg that back in the fall, Microsoft observed individuals they believe may be linked to DeepSeek exfiltrating a large amount of data.
And this piggybacks on what David Sachs, who is Trump's artificial intelligence czar, said yesterday in an interview where he said there is good evidence of DeepSeek doing something called distillation, where basically they take the output from an OpenAI and they use it to recreate the model that they're using. OpenAI tries to prevent this with different types of protections for their IP. If this is true, does that change the story to basically make it less impressive because it wasn't necessarily a $5 million effort to quickly, on cheaper chips, recreate OpenAI?
We saw some big moves on Monday, and now we're all asking the questions. And these are the right questions, just what exactly was going on here. I've got another one. I want to know how the hedge fund that's affiliated with DeepSeek actually fared on Monday, how it was positioned, whether it did well off the back of this sell-off or not, because there was a heck of a lot of money to be made given this sell-off.
That's next level conspiracy theory. I love it.
I just want to know.
I've got a feeling that the Chinese won't investigate and release that report publicly, but it is a good question. Look, there are a lot of questions. That said, the moves in the market have been interesting.
Yeah.
What stuck and what didn't stick? NVIDIA walked a lot of it back. Meta, Microsoft, they walked a lot of it back yesterday. The ones that didn't were the infrastructure plays. And that, I think, is telling and actually speaks to a larger issue regardless of DeepSeek.
Worth pointing out also how much of this conversation took place on X. And shout out to Joe Weisenthal, our colleague, of course. Joe's fantastic on these things. Joe, one of the early people on X to ask the question, if this is real, it raises big questions about what's happening as an investment thesis in things like NVIDIA and other tech plays. And that buzz that we saw over the weekend was almost exclusively on X. It's a lot of sophisticated people giving their thoughts about what would happen on Monday. And it was like back to back, Monday, or rather Saturday through Sunday. I woke up Saturday, it was all anybody was talking about.
Which, again, speaks to, we knew about DeepSeek for a while. What catalyzed this moment where suddenly this was it and everyone realized this could potentially change the model?
Number one in the download charts, I think changed things a lot and changed it pretty quickly. Elsewhere, Apple has been secretly working with SpaceX and T-Mobile to add Starlink satellite support to the latest iPhone software. Sources telling us here at Bloomberg about this surprise tie-up. The latest iPhone update rolled out Monday now supports Starlink service.
To me, this is such a boon for T-Mobile, and I'll explain why. Members of my family and myself, they have T-Mobile, I have Verizon. And when we go on a hike or we're in a remote place, they lose access right away, and I don't. And this is basically T-Mobile saying, we got your back, because you can get your texts and you can read your news, if you're in the United States, in a remote place, by using Starlink. There are broader implications, of course, about Starlink and how it's going to be used in a commercial sense. But to me, that's the most interesting aspect, is how this could potentially change the game on a competitive level.
Do you wind up family members about cell phone service? Is that what you do? Is that actually what happens on your hikes?
Well,
Okay, Bram.
Look, if you're on a hike and you want to know where you're going and you want to know how much further you have on the hike,
of course.
Right? So I can do it, they can't.
All right.
If we're in a car and we're in a rural place,
You're in control.
I'm in control. I can look it on maps. They cannot.
I'm sure you don't abuse that
Never.
at all. As we count you down to President Trump's Saturday tariff deadline, the White House saying it's prepared to slap 25% tariffs on North American trade partners Mexico and Canada. The Canadian politician Chrystia Freeland, running to replace Prime Minister Justin Trudeau, telling us here at Bloomberg she sees Trump's tariff threats as a pathway for tougher policy on China.
Some of the rhetoric was really quite colorful from her in this interview with David Gura. He has come to the conclusion, Trump has come to the conclusion that if he can show the rest of the world how mean and tough he can be with his closest partners and allies, how much he's prepared to beat up on those really nice Canadians who throughout history have been great partners for the U.S., how do you think he's going to make China feel? So basically, they're looking at this as, okay, we're being used as a negotiating pawn, but we're your nice allies, and we want to work with you with respect to China. You go further in the interview, and then she's like, by the way, if you do this, then we'll also put all of these tariffs on because we know, just like any kind friendship, you disrespect us unless we actually actively fight back. So, thanks.
We'll see how this actually works out this weekend and beyond. Anne-Marie's going to continue the conversation. She joins us from Washington with a special guest. Hey, Anne-Marie.
Hey, John. Yeah, I'm with someone who's actually been in the room prior during Trump 1.0 negotiating some of these trade deals. Kellyanne Shaw, former senior White House trade advisor under Trump, now at Hogan Lovells. Thank you so much for joining us. So we're counting down to this deadline Trump just kind of threw out there. February 1st, it's on Saturday. Do you think he follows through?
I do. I think the most important thing about negotiating for President Trump is that when he says he's going to do something, you have to take that threat seriously. And this is something that he's been talking about for months. It was back in November that he originally said he was going to impose these tariffs on both Canada and Mexico for immigration and fentanyl. And so now he has doubled down and said that he is following forward on February 1st.
So do you think we'll see 25%, or do you think it's going to be more of a gradual approach to get to 25%? Will he give importers 90 days? What's some of the details we can expect?
Yeah, well, at the end of the day, it's the president and the president alone who makes the final determination on tariffs, including tariff levels and product coverage. And I saw that many times, that this was his decision to make. But he has said several times over the past couple of weeks, it's 25% on Canada and on Mexico. So that's what I'm expecting. But just from a practical perspective, in terms of implementing tariffs, you often need a couple of days of delay, if not a week to 10 days, just to give importers notice, like brokers know, update the HTS and some of those logistical issues before they go into effect. But I'm expecting him to announce tariffs and tariffs that would go into effect pretty soon.
And they stay, or is this a negotiating tool?
I think there are two different types of tariffs when it comes to President Trump. There are the tariffs he talks about that may be used to address the U.S. trade deficit, to some of the economic concerns, some of the supply chain issues. And then there are tariffs for non-economic reasons.
Like Colombia over the weekend.
Like Colombia, like Canada, like Mexico, immigration and fentanyl. And those, it's purely about putting pressure on another government to try to take certain action. So I'm not expecting those tariffs to stay in place very long, provided that Canada and Mexico come to the table.
We have not mentioned China, yet we're having an entire discussion on tariffs. Does he announce 10% on China on Saturday? Why have they been so quiet when it comes to Beijing?
Yeah, and he's been a bit ambiguous on what he's going to do with China in terms of the 10%. At one point, he said he was going to move forward with it. Another point, he said he's still considering that. I think the press secretary said yesterday it's still on the table, but she wasn't certain or at least definite about whether China tariffs would go into effect. I think there's a longer play here. If you look at the memorandum that the president issued on day one, he is directing his USTR to do a review of the phase one deal. He's directing his USTR to look at the tariff increases that President Biden put on. And I think he's teeing up for a broader negotiation. So it could be, let's not muddy the water in the short term, and let's wait until after April 1st, until we're getting ready to really engage with China before he moves forward with action, because that's the most consequential economic relationship in the world.
You negotiated phase one trade deal. So how much further do you think Trump 2.0 will take it?
Well, part of that depends on China. And so when we negotiated the phase one deal, we were very much focused on a number of the issues that were at stake in that Section 301 report. And it was very clear to us that the president wanted us to get China to stop stealing U.S. technology, stop engaging in unfair trading practices, and stop subsidizing certain industries that made U.S. exporters less competitive around the world. And we were able to get China to agree to a number of substantive provisions as well as the purchasing commitments, but China hasn't lived up to that deal. And I think that's pretty clear. And so it's a matter of, will China be willing to come to the table with the second Trump administration, not only fulfilling the obligations of the first deal, but seeing if there's a possibility to take it even further. And that's going to be up to the president to see, does he want to negotiate a phase two deal, or does he just want to keep China accountable to phase one?
Where is Congress's role in all of this? Or does Trump do everything on tariffs unilaterally?
Well, as every trade lawyer knows, the tariff authority is Congress's under the U.S. Constitution. But over the past 100 years, they've delegated much of it to the executive. And so it's hard for me to see a Republican-controlled House and Senate passing legislation to push back on Trump's tariffs. I think for me, a better question is, are they going to give the president more authority? Or are they going to lock in some of the China tariffs by revoking PNTR? Are they going to give the president authority to do what he's talked about in terms of a universal baseline tariff? And I think that's a question that's going to be negotiated as Congress considers the Tax Cuts and Jobs Act and some of the other major legislative priorities over the next year or two.
The way you're speaking, it definitely sounds like, especially to the business community, that some level of tariffs are here and they're here to stay for the next 4 years under this administration. What should the business community be looking out for? Because I know a lot of them are just on edge because there's no clarity yet.
Yeah, and that's the thing, too, right? Like, as a former negotiator, your currency is ambiguity, which is really
it's a
effective.
feature, not a bug of Trump.
Exactly. And so it's really effective when negotiating with other trading partners, but it does give less certainty to the business community who's trying to figure out where all of this is going. But what I can say is during the first administration, Trump landed the plane in terms of these negotiations. And so hopefully he lands it in a second administration as well. But I think for my clients, what I'm advising is make sure you know where your supply chains are. Try to understand the transparency in your supply chains. Where are you vulnerable? Where do you have alternatives? And buckle up, because I think this is going to be a pretty interesting ride over the next couple of months and years as we see some of these negotiations unfold.
Let's end on that, buckling up. What kind of retaliatory measures do you think we can see from whether it's Canada, Mexico, or China?
Yeah, well, I think that Canada has talked pretty publicly about some of the retaliation that it intends to implement. And there, what I'd say is I don't think that that's necessarily the most effective strategy. It's not going to get the president to back down, right? He is very focused on resolving fentanyl, resolving immigration. And I think the sooner that Canada comes to the table on that issue, the sooner that this particular trade row goes away. But certainly Canada, Mexico, and China will retaliate in the form of tariffs. There may be other types of measures that they're looking at doing. The European Union has also spent quite a bit of time looking at potential retaliation. So I think there's going to be a flare-up if some of these tariffs move forward, not just in terms of what the U.S. does, but what other countries do back to domestic exporters.
And just finally, if there's going to be retaliatory measures, at the end of the day, does Trump just want better deals to have fairer trade?
Yeah, and again, it goes down to the two purposes for tariffs, right? If you're just doing it for non-economic reasons, it's to exert pressure on other governments by using like all the tools in the U.S. toolkit. But when it comes to resolving some of these unbalanced trading relationships and the fact that the U.S. has some of the lowest tariff rates in the world, well, for the past several decades, our trading partners have maintained higher tariff rates and barriers to trade. He wants to see those tariff barriers and those tariff rates come down. And so ultimately, hopefully, that's where we land. But we'll have to see. And it's two parties at each end of the table.
Kellyanne, thank you so much for your time this morning. John, that was Kellyanne Shaw, former senior White House trade advisor. She's now at Hogan Lovells. What I find so interesting from that conversation is, of course, she says it's happening on Saturday. Trump is serious when he talks about these tariffs. And really, when it comes to Saturday's decision, it seems like it's really being driven by fixing immigration and fentanyl.
We've seen that on repeat over the past few weeks. Annmarie, thank you. She's taken it seriously. I'm not sure this market is just yet.
Yeah, especially because a lot of people are saying that this is just a negotiating tool. If it goes into effect, though, and you get retaliatory tariffs, just how big could the reaction be, particularly in those auto manufacturers?
We saw a hint of that yesterday with GM down hard, even with some decent numbers. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny. I'm going to jump in here, Danny. I believe your mic was unplugged. If we can go back to the start, I'll bring you the Bloomberg Brief. Should we do that?
Please, go ahead.
Let's do that. OK, your first story. White House AI czar David Sacks said there is substantial evidence DeepSeek leaned on OpenAI's models to help develop its tech. In an interview with Fox, Sacks said they used a technique called distillation, where one AI uses the output of another for training purposes to develop similar abilities. OpenAI is investigating whether DeepSeek used distillation or independent research to develop its tech. Elsewhere, French spirit maker Rémy Cointreau shares are lower in European trading after the company reported a major dip in sales in the fiscal third quarter. Rémy Sales expects full-year sales to fall close to 18%, with US consumers pulling back on pricey spirits and the ongoing China downturn. Rémy will implement a wide-ranging new cost-saving plan. Analysts expect to see improvement in the fourth quarter. That stock is down 5%. Drink more cognac. Seems to be the message coming from them.
Yeah, you saw that with Moet, the same kind of Moet Hennessy coming out of LVMH, also really struggling. How much is this China? How much is it just the craft kinds of spirits?
Have you been to cognac? I've been to Hennessy.
Really?
Yeah, south of France, southeast.
You're not a drinker.
Southwest, right?
Did you actually taste anything?
I Saint-Emilion.
Or did you just sort of admire the scenery?
I was 10 years old.
Oh.
What do you think I was up to, Brammo?
I have no clue.
My dad was super into these things. At the time, I was not, okay? Elsewhere, French President Emmanuel Macron announced a major renovation and expansion of the Louvre Museum. The project, branded Louvre New Renaissance, will take up to a decade and is estimated to cost over $800 million. A major change will be a private room dedicated to Leonardo da Vinci's Mona Lisa that will be accessible to viewers through a special ticket.
Okay, for those who have actually gone to the Louvre and seen what the lines are like to see the Mona Lisa, you have to wait to get into the room, and then there are all these crowds around, and so basically you start looking at the other paintings, which actually are pretty good, but it's just sort of telling how you can monetize.
How much is it going to cost to get the extra ticket, right? What's the price of that going to be?
Enough for them to actually pay for some of these renovations.
You a big fan of Paris, France?
Well, I like going to museums, you know.
Okay.
Yeah, why?
No, just intrigued. There's always Italy. Anyway, up next, squeeze that in every single time. There was so much France and French stuff in that newsread.
Okay, so that was offensive to you?
Macron,
yeah, okay,
Rémy.
all right, fair. But, you know, in fairness, Mona Lisa.
Enough of that. European diversification. Up next on the programme, the Fed's first move under Trump.
The Fed, and you've heard me say this for a long time, has got to get more strategic in its approach and has got to stop being excessively data dependent.
A conversation up next, live from New York City. This is Bloomberg. Big trading day coming up. Lots of earnings after the closing bell. Microsoft, Meta, Tesla. Big Fed decision. It's a major Fed decision at 2 p.m.
Cut it out.
Just trying to promo our coverage at 1:30. It's not a major decision, but we'd love to catch up with you a little bit later on. News conference at 2:30. Is it a skip? Is it a pause?
Wow, you're really selling it.
Could he consider a rate hike later on this year?
Absolutely not.
And will Donald Trump phone in?
That's also probably a no, but that would make it more interesting.
Wouldn't it be really interesting if someone got the text in the news conference and just read out the question?
You're basically you're leading the witness.
I know the president tunes in sometimes, so if you're listening this morning, you should do that. I can give you the number of Mike McKeon. We'll make that happen.
Oh, great.
Wouldn't that be great? The president writes in, he wants to know XYZ.
Right.
That's how you make this interesting.
All right, well, you're trying. You're doing a great job. Keep going.
I'm a content guy, you know. Under surveillance this morning, the Fed's first move under Trump.
The Fed, and you've heard me say this for a long time, has got to get more strategic in its approach and has got to stop being excessively data dependent. They've been confused in their analysis, they've been confused in their communication, they've been confused in their approach. When you're data dependent and you're just looking at the future through the lens of the past, you will get more and more confused as we go through these changes.
So here's the latest this morning. The Fed expecting to announce its first interest rate decision of the year, and its new first under the new Trump administration. The consensus widely expecting a pause. The former Kansas City Fed President Esther George joins us now for more. Esther, welcome to the programme. We're all looking forward to Chairman Powell a little bit later. How boring can he make this, and is that the objective later on this afternoon?
Well, I think he'd love to make it just as boring as he can, in the sense that it doesn't stir up new speculation. So we'll see. He's got a tough job.
Well, what do you think, Esther? The idea that right now markets are really concerned that the Fed might be on a path to basically hold rates here for the rest of the year. If he is asked that, how would you characterize not doing anything today, a pause or a skip? How will he answer?
Well, Lisa, I think we got a clue from the December meeting, right? The minutes have told us that there was a sense that inflation was not coming down quickly enough, that disinflationary process may have stalled out. And so for their mandate, they have to be cautious at this point, I think, and watch to see how things will unfold. The challenge for them, of course, as it is for many people today, is saying, how do you manage through this uncertainty? How do you look at the risk and the outlook ahead when you don't have clarity in the moment? And the truth is, you rarely have that clarity. It may be unusually high right now in terms of uncertainty, which means you have to pivot, in my view, to thinking about the long run. And that's where I hope we hear the focus, not so much on next month's data and the next, but really where we're coming out in the long run for inflation.
Esther, there's also the added complication right now that we have a really disparate Fed, right? The different Fed members seem to be pretty split. Is this a unique feature right now? Does it seem like it is more divided than it has been when you were there or in previous administrations?
So I think there is always a diversity. That is the design of this committee. I think what creates what may sound like dissonance right now comes at what I call turning points. There are times in the economy when the decision-making is less clear, when the path ahead is less clear, and that's when you will tend to see surface in this discussion a range of views. And depending on how strong those voices are, the chairman has to bring those together because you have to make a decision. And sometimes that decision is to wait and see. And I think today is going to be one of those times.
Esther, I'd love your view on what you'd be doing. How would you balance the evolving data with expected policy changes? Where would you put the most weight?
So for me, the weight is always on thinking about the inflation, because that is the most direct influence that the central bank has on its mandate. And having seen the disinflationary process slow down, we are now in a fifth year of inflation running well above the Fed's target. I would be in a position myself to say, we can wait, we should wait. The economy is performing well. We have a number of risks that are evolving here in terms of telling us what the outlook might be. And now seems a particularly good time to sit on the sidelines and wait for more clarity.
Esther, it's good to hear from you. We miss your voice on the FOMC. Esther George there, the former Kansas City Fed president, Esther George. And I would say the argument that she's put out there is probably the strongest one on the FOMC at the moment.
Yeah, the idea that you have to wait and not call it a skip or pause and just say, we don't know, we have to wait. Of course, there could be questions, what are you waiting for? Do you place the emphasis on inflation the same kind of way that Esther George is? And then how much has the recent decline in long-term yields actually given some breathing space to a Fed that previously was being accused of making a policy error?
This is what some of them seem to be finding difficult. How much weight do you put on the data? How much weight do you put on expected policy changes? Some incorporating them, others not. Apparently none of them were going to do that back in November, then some did in December, and we'll see where they are in January going into March. Coming up, Binky Chadha of Deutsche Bank, Pierre Ferragu of New Street Research, Blerina Uruci of T. Rowe Price, and Krishna Memani of Lafayette College. This is Bloomberg.
It'll be very interesting to see what the earnings reports are going to be like. It's not great to have the entirety of your capital in 7 names.
It really does accentuate that need for diversification.
When you have leaders in technology, they tend to stay leaders.
Big tech, you've got growth at a reasonable price. I'm not necessarily worried about the valuations here.
These big tech names, though, are not an obvious loser to me.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Trying and failing to pace myself this week, given that by the time we finished Monday, it felt like the week was over, but of course it had just started. And it continues. Later on today, we get earnings from the big tech players, Microsoft, Meta, Tesla, if Tesla's considered a big tech player. And then the big one, the Federal Reserve.
You're just crushing it.
Trying to promo the Fed here.
Are you? Okay, carry on.
The big one at 2 p.m. Eastern Time, the Federal Reserve decision. And Chairman Powell news conference 30 minutes later. Will they or won't they?
Will they or won't they speak English as they get to the podium and actually try to say nothing, because
Probably,
it's going to be like completely
probably a better
boring.
question.
Yeah, I mean, honestly.
Widely expected to keep interest rates unchanged at 2 p.m. Eastern Time. Skip or pause? How will they characterize that move?
Okay, look, honestly, A+, to try to make it interesting in a time where Jay Powell is going to do everything in his power to make it as boring as possible and to not provoke the president to write in, just as you've asked him to do.
Binky's tuning in. Special coverage on Bloomberg TV and radio. 1:30 Eastern Time.
Oh, yeah, Binky's really excited.
See how keen we all are for this later.
Well, look, okay.
Federal Reserve.
First of all, it has been a long week just simply because the markets have been really exciting, but that's what we live for, so that's very exciting for us. But there is this larger question of everyone's expecting the Fed to be boring. Could it be the stealth disruptor at a time where Lisa Shalett of Morgan Stanley was talking about how ultimately the reason why multiples have not been expanding for stocks over the past couple of months has been bond yields, and they have been the main driver for broader equity valuations. So should there be something said this afternoon, it could be quite impactful.
The 10-year, the last time the Fed met on December 18th, at the close that day, was just above 450. The 10-year this morning, 452.
Yeah.
So that's what we've been up to.
Okay, all right. Okay, you're crushing it. You're just trying to get us so excited for this. It's just unbelievable.
I do think, I will say this, language matters, and there is a difference between communicating a skip and communicating a pause. They mean two very different things.
I also am curious how Jay Powell communicates the dissent that seems to be growing on the FOMC. And Esther George, formerly of the Kansas Federal Reserve, was talking about how this is typical during periods of uncertainty. That said, it seems as though there is a political overtone at a time where Jay Powell's term comes up in 2026, and there are some people who are going to look through a lot of the policy proposals that we're talking about.
Go deeper, not just dissent, ambition. The ambition of some on the FOMC who would quite like to fill that seat at the Federal Reserve. How much that's going to complicate communication over the next several months as well.
Yeah, can you imagine if actually one of them just sort of came out on the podium?
Yeah.
Sat next to him. We're trying to imagine ways this could be
do
really
that at the ECB.
fascinating.
It would make it more interesting if more of them came out. And you could hear from the others as well.
Or even look at their facial expressions.
I'm just saying that for Governor Waller, there's been a real change, I think, from Governor Waller. And when you speak to people, when you speak to them privately, they're much more willing to say that it sounded like an audition. Neil Dutta of Renmark basically said it in a note in the last few weeks.
There is a sense that his coming out and saying really vocally that some of the tariffs would not affect the downward trajectory of rates and that he still sees the disinflationary process well underway clearly was playing into the hands of a policy that this president has at play. That said, there are a lot of people who would agree, and it all depends on exactly how those tariffs are implemented.
We just talked about the Federal Reserve for 4 minutes, and if you're just tuning in, that's 4 times as much as we have throughout the whole programme so far. Coming up, Binky Chadha of Deutsche Bank as stocks move higher ahead of the Fed. Pierre Ferragu of New Street previewing earnings from Tesla, and Blerina Uruci of T. Rowe Price counting down to the first Fed decision of 2025. We begin this hour with stocks little changed. Investors looking ahead to this afternoon, a Fed decision and earnings from Meta, Microsoft and Tesla. Binky Chadha of Deutsche Bank also keeping an eye on Trump's tariff policy, writing equity markets at record highs will be tested by more trade escalations. Equity positioning is elevated and will continue to whipsaw on trade headlines. Binky joins us now for more. Binky, good morning.
Yeah, good morning.
It's good to see you. Thanks for sitting through that. We appreciate it. Let's talk about trade. It's a key deadline this weekend. Are you expecting a change?
I think it's pretty close to 50-50. I'd put the odds of getting something big below 50. Yes, the note you read out from Friday, we did have a peak in the market last week, and the script from the last trade war was markets do well. Emboldens basically the stance on escalating on trade. Market sells off, which we also had on Monday. Sort of changes the dynamic a little bit, and there's a reason for a pause.
So let's split up the two stories if we can. Can we just sit on trade just for a while longer?
Sure.
Do you think it caps multiples of the companies that are exposed to that story? And is GM a decent example? Lisa brought this up earlier. GM came out with fine numbers, but I think people found it difficult to put much weight on the outlook, given how trade dependent that might be. How does that complicate valuations going forward for those sectors?
So far, I would say in general, and going back to the note on Friday, so things moving around pretty fast. Sure. But if you take a look basically at the market down, the market recovery. I mean, basically, what you're seeing is actually, the most tariff-exposed sectors actually outperformed the market slightly. So they're moving with the market. So I would argue, right now, the equity market has not really priced in anything for tariffs. And that, we can debate whether that's reasonable or unreasonable. I would argue, tariffs are going to come. They're in our house economics baseline. Of course, the precise numbers, magnitude, trajectory, timing, can be different. But we have still basically, one of the highest macro forecasts from Matt Lazzetti on the street for what growth's going to do this year. So I would argue what matters for equities at the end of the day is what that does to growth. And right now, I think it's just a little bit unclear. There's not just the tariffs, but there's plenty of other things happening. I would also point out, in terms of thinking about the tariffs, there's a number of things that are pretty different this time relative to the last time. Last time around, I would argue, the tariffs were really a big surprise. This time around, it's arguably the most anticipated, most talked about policy change that's coming. And so the dynamics are going to be very different when something is a surprise and when something is anticipated.
Okay, so you've said two things here. I'm jumping in because you said that on one hand, it's not being priced in. On the other hand, it's not a surprise. So can you reconcile those two things in terms of which sectors, which have been relatively immune to concerns about tariffs, could potentially see the biggest drawdowns if we do see on February 1st, on Saturday, these tariffs implemented?
So I would add two more things before I answer your question. And what I would say is, if you talk to companies and listen to companies, and one of the reasons why things are not priced in on the tariff front is they tell you that basically, since the last trade war, we've had basically a lot of experience, courtesy the pandemic and geopolitical issues, on managing our supply chain. So I would, as we say, basically, companies say they're essentially battle ready, bring them on. I would also point out that, this is about a change in U.S. trade policy and higher tariffs. But, as one company put it, look, we have tariffs in every country and they change around all the time. We have to deal with it. So, I think there's a shock impact that the fact that the U.S. is going to do it. And I think that basically, it's diffused somewhat by being highly anticipated, not perhaps the precise, magnitudes and the direction, but I would say otherwise, I think the market's in a pretty reasonable place on the tariffs. Yeah.
What's fascinating to me is that the market might be in a reasonable place, but you also point to how high evaluations are and that people are feeling jittery, and that tariffs being announced, or say what happened over the weekend with DeepSeek and how much that rattled the tech industry, is indicative of where we are in a market cycle and the nervousness about valuations. How are you adjusting your outlook based on that, just that kind of dynamic alone?
So actually, our view for the year is that there are good reasons for why multiples have gone up, and our bottom line is multiples are likely to stay here, if not squeeze higher, is the way I would put it. Sort of a longer discussion, but I would say at least sort of 4 reasons for why multiples have gone up. One is sort of an older reason. I mean, everybody talks about 15 times as the historical average for the S&P 500. I mean, if you take a look at just the trailing multiple for the S&P 500, we really haven't spent much time below, 15 times since the late 1980s. So multiples moved up earlier, and that I would ascribe to basically inflation moving to a 2% world from what it used to be. Number 2, I would say, take a look at total payout ratios in the U.S. They used to be between 50 and 60%. At the tail end of the post-global financial crisis cycle, we ran up to 80, 85%, and we stayed there for a while. It's huge change in payout ratios. So, that's a 45% increase from 55 to 80. That's a 45% increase in the earnings that go to shareholders. And then, if you just did a quick present value calculation, it would tell you that if payout ratios go up by 45%, fair value multiples should go up by 45%.
How much of this is linchpin?
Two more reasons why multiples are.
Well, but hold on one second. Can you do it quickly?
Absolutely. So, what is trend earnings growth for the S&P 500 over the last 100 years or 90 years? It's 6.5%. But if you take, a rolling 10-year read on what earnings are doing, we're running at 9%. And when was the last time we had as high a number for rolling 10-year earnings growth? It's the second half of the 90s. And then I would say, take a look at, the risk in equities at a fundamental level comes from earnings and big drawdowns in earnings. And, those have generally been associated basically with recessions. So if you just take, the crudest metric, how long has it been since a 10% drawdown in earnings? And what you will see is that that's arguing, multiples are following that. Multiples followed that in the second half of the 90s. And so, that's why I say multiples could squeeze higher. They're pointing a lot higher. Yeah.
Binky, appreciate your time and the explanation.
Pleasure.
Got through all three in the end without Bramo's interruption.
I'm sorry, I feel rude. I was getting so excited. There are a lot of ideas baked in there, and so I wanted to develop, but we don't have time.
The limits of TV. Binky Chadha at Deutsche Bank. Binky, it's good to see you. Thanks you, sir.
For having me.
Equity futures just rolling over. We're negative by 0.1%, a little more. We're down by close to 2 now. Let's get you an update on stories elsewhere with your Bloomberg brief. Here is Danny Berger. Hey, Danny.
Hey, John. The U.S. Navy has been instructed not to use AI from DeepSeek, according to CNBC. The Navy said DeepSeek's AI is not to be used due to potential security and ethical concerns associated with the model's origin and usage. The announcement follows the release of DeepSeek's R1 model that shot to the top of Apple's App Store after the company announced its tech rivals that of OpenAI and Meta. President Donald Trump and Elon Musk announced last night that SpaceX will retrieve true astronauts from the International Space Station, quote, as soon as possible. It's assumed that they're talking about Suni Williams and Butch Wilmore, who have been living on the space station since early June. The astronauts are already scheduled to return on a SpaceX capsule in March as part of a NASA mission. The capsule for the return journey is already docked at the ISS, and NASA has not commented on any changes to the mission. You can now use the official Trump meme coin to purchase watches and sneakers. Several websites selling Trump-branded products have started to accept the coin as payment. The meme coin's total market cap reportedly exceeds $5 billion and is now being accepted by other businesses like the travel site Travala.com. And that's your brief. John.
Check it out. Danny, thank you. Thank you very much. Up next on the programme, the Morning Calls Plus. Pierre Ferragu of New Street Research previewing numbers from Tesla. That conversation next. This is Bloomberg. You looking for vacations?
I'm just exploring Travala to understand exactly the cryptocurrency. Well, you can do cryptocurrency, but it looks like the prices are somewhat higher and it's very slow. But I just had never heard of Travala before.
Okay, and is it like Expedia?
Well, yeah, it's sort of, but it's a lot slower and it has cryptocurrency accepted in every...
What about the range of hotels? And
I can't do that much research. I'm trying.
All right.
Actually, no, it wasn't more expensive. This is how much the costs are. Jeez.
More expensive?
Than I thought it was going to be. No, it is. It's just in general. Things are expensive.
Okay. Welcome. Equities look like this. I was going to say it's Biden's America, but of course it's not anymore. Equity futures down by 0.1%. Do you remember that? They'd put those stickers by the gas pumps and said Biden did this.
Yeah. Well, gas is actually really cheap now, but hotel rooms, forget it.
Not so much. Crude's lower by 0.2%. The 10-year just about unchanged. Yields down a basis point, 4.52. Let's get you some morning calls. First up, KeyBank raising its price target on Meta to $7.50, saying open source technology will drive cost savings. Your second call from Oppenheimer, downgrading Apple to perform, citing reduced iPhone sales and competition in China. That name is down by 1.2%. Earnings from them tomorrow. Big story. And finally, Wells Fargo hiking its price target on GM to 37, citing potential tariff impacts on its bottom line. Sticking with the automakers, investors bracing for Tesla earnings after the closing bell. Joining us now to discuss, Pierre Ferragu of New Street Research, who recently upgraded Tesla to a buy and raised his price target to 460 from 240. Pierre, welcome to the programme, sir. Let's start with the upgrade. Why the upgrade and why Monday?
So we did upgrade the stock a few weeks back, and really our view was looking at 2025 on the auto business, what's all the news flow that gets delivered quarter after quarter on the volumes and gross margin. We don't see yet, green shots. We don't see like a recovery in demand, but we see like a situation where we are very close to the bottom. So from here, very limited downside risk. And at some point, we'll get new models. There is a new Model Y coming through right now. There will be new, lower price point models that are going to help volumes. And at some point, pricing will ease, the pressure that Tesla is under, like the rest of the auto industry at the moment, is going to ease. So things look relatively nice on that one. And then there is FSD 13. FSD 13 is really like a turning point in terms of self-driving capabilities. And even if we still see many, many years before you see a very large number of robotaxis from Tesla on the road, we think this year the news flow and evolution is going to be very, very positive and is going to support the sentiment on the name. So what we're going to see this year is probably the release of the first unsupervised version of FSD, this idea that you can have your car driving you around and you don't need to keep an eye constantly on the road. And then the technology is probably right now to see test fleets being deployed, and the company mentioned it in recent months, and we expect that to happen in Texas. So this vision where Tesla becomes a company that can produce millions of robotaxi every year and redeploy them across the country and across the globe, it's still a multi-year vision, but it's going to get more and more tangible this year. And so the stock now is trading maybe on 100 times earnings, which is where it has been trading when the market started really focusing on the long-term vision and saw the long-term vision becoming more and more tangible. That's really what we expect for the stock this year.
As you say, Pierre, this is the big long-term story. If we can get super near-term and just think about the last quarter and the next quarter, if I can just sit on that just for a moment, what did we learn yesterday from the likes of General Motors? What did we learn from them about how sales are developing and whether pricing power is sticking?
Yeah. So what we've heard is the same story we've heard in the last 15 months, which is that auto demand is not recovering yet. It's still at a very low point. And so I wouldn't be too, demanding on what to expect tonight in terms of numbers. So we know already deliveries, they're slightly down year on year, recovering sequentially. They are 30% above the run rate of the beginning of the year. So Tesla continues to be able, to expand even in this very difficult market condition. But that we know that there won't be any surprise. We already know the delivery numbers. What's going to be interesting, of course, is the gross margin. We do expect pressure on gross margin. It was particularly high in Q3, it benefited from a lot of tailwinds. And what we've seen in Q4 is that Tesla has still been very aggressive, very active on discounting, on promotions and things like that. And of course, this means the pressure on gross margin is still around. It's well into expectation. The key question is, can Tesla deliver 20 to 30% growth, as Elon indicated for 2025? And on that one, I would say, if we close 2024 on a run rate that is 30% above, 20 to 30% above where it was at the beginning of the year, we're in a good position to do that. And what we need to hear on the call to gain confidence about 2025 being a good growth year for Tesla is actually some more insights on how the new Model Y is doing and what comes next this year in terms of new models. Because remember, in auto, we are facing an extremely elastic market. If you can get into the market with lower price points, you massively, instantly expand your addressable market. And that's really what Tesla needs to deliver this year to deliver a very strong quarter after quarter, sequential trajectory.
So right now, Pierre, the actual numbers in terms of deliveries and sales might not matter as much as some of the longer-term story that you're talking about. Margins do matter. We are going to also be hearing from Apple and Microsoft, both of which you cover. Do you think that their earnings are going to be actually more important than even Tesla's in giving a sense of direction for the stock, but also for how they are going to invest?
Yes, I think you will have way more attention on Microsoft and Apple tonight than on Tesla for the reasons you just mentioned. The market for now is wondering who's going to invest in the AI infrastructure going forward, and is like the AI infrastructure deployment still as vivid as we expect? And yes, that's going to be most of the focus of the market tonight. And of course, Tesla is deploying a lot of AI infrastructure, but it's going to be very secondary on the earnings call tonight.
Pierre, you have a neutral on Apple. You've had a neutral on Apple, a neutral rating on Apple for quite a while. What would you have to hear this afternoon to make you more bullish at a time where some people are saying that Apple actually looks like they were wise to not throw as much money into AI development at the earlier stages of adoption?
Yes, it's a good question. Yeah, it's actually very difficult to be bullish on Apple at this level of valuation, simply because the laws of large number applies to the company. There isn't a bull case, re-accelerating earnings growth for Apple. So it's a very high quality company, a very high quality name, and it's reflected in the stock price. And so when you have like a maxed out multiple and very limited earnings growth potential, like single digit, maybe low double digits earnings growth potential, it's difficult to get excited about the stock. So I think my neutral rating that now is like several years, has been in place for several years, is really a rating that is waiting for like a better opportunity to get into the stock. And unfortunately, today, Apple is facing actually a bleak outlook. You see more and more downgrades from my peers, because yes, that's something we've been calling since the summer, which is that the outlook for the iPhone is not good. Like this AI evolution is actually going to be a multi-year evolution for Apple. It's not going to have like a positive impact on the momentum of the business in the near term. And so this year should be relatively weak for the iPhone, because people will wait for the next iPhones, and people the replacement activity has been quite strong in the last couple of years. So I would expect a bleak outlook, and maybe the stock reacts negatively to that and creates an opportunity actually to buy a very high quality staple name. But that's really valuation that is an issue for me here.
Not trading with the valuation that you like. Pierre, thank you, sir. Pierre Ferragu there of New Street Research on Apple. Apple and Tesla similar in one way. The core business is not seeing any growth. The difference is that Tesla has got this grand vision of the future that Apple right now doesn't have.
Although some people are saying that they benefited from not investing as much in some of the chips in the data centers, if what we saw is true.
Up next on the programme, a sprinkle of economic data from New York. This is Bloomberg. $60 minutes away from the opening bell, with equity futures on the S&P down by 0.25%, just a little bit softer. In the bond market, 2-year, 10-year, 30-year shaping up as follows. Going into some economic data in just a moment, and of course the Federal Reserve decision later on this afternoon. The 10-year at 451.83, very close to where it was at the close the last time the Fed met on December 18th. The 2-year opened up that day at 424. The 2-year right now 418.87. With that data and looking ahead to that Federal Reserve decision, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, we're calling this one number to rule them all. We haven't talked much about trade in recent years, but since it's the way Donald Trump keeps score, let's take a look at the advanced goods trade balance that just came out, negative $122 billion. That is far, far higher than the previous $102 billion, and certainly way above the 105 that was forecast. Now, this does not include services. We'll get the total trade balance next Wednesday, but we are starting off on a bad foot here. These are December numbers that comes into the Trump administration with the trade deficit widening, and he's definitely not going to like that, and that will probably feed into whatever happens this weekend.
Mike, how much of that is just front-loading orders ahead of potential tariffs?
That is a very good point. A lot of people have suggested that perhaps that's what companies were doing, trying to stock up. And there are folks, Joanne Chu at the University of Michigan says when they have called people for their survey, Americans have said they've wanted to buy things like cars and refrigerators ahead of time because they're afraid prices are going to go up. So we're going to have to watch that as a possibility and see if once we get to the January numbers, that comes back a little bit.
Mike, thank you, sir. Stay close. Mike McKee, of course, down in Washington today because Mike McKee will be in that news conference for the Federal Reserve a little bit later on this afternoon. We expected some front-loading, didn't we? Seems like we're getting a bit of it.
What's interesting to me, and I don't know much sort of insight into exactly why, but I'd love Mike's thoughts later on about the wholesale inventories actually fell and they were expected to rise. So if they're stockpiling, it's not showing up in inventories, which is interesting to me. How much are we actually seeing stockpiling versus how much are people buying ahead of any potential tariffs, given that it is sort of filtering into the zeitgeist?
I think Mike's still there. Do you want to ask him?
Yeah, I do. Mike, what do you make of that? If you could tell us about the idea of wholesale inventories declining by 0.5%, even though they were expected to increase. If we actually saw stockpiling, wouldn't we expect that to go up?
Well, we would, and that's an interesting question. It's a little hard to pull out wholesale inventories and retail inventories also out this morning showing a decline because of the holiday season. It is possible stuff came in and went back, right out the door, and we don't know exactly the composition of that yet. But I'll look into it and see if we get enough of a breakdown to be able to tell.
Mike McKee, thank you, sir. We'll throw these questions at someone else and see if we can get an answer. Blerina, Uruci of T. Rowe Price. Economists are all the same, aren't they? On one hand this, the other hand that. Blerina, we want answers. How do you explain the data from a few minutes ago?
I would go back to the U.S. consumer because we're not seeing any evidence in the Q4 GDP tracking data that we have an inventory buildup. When you look at the contributions there, inventories are actually the only component that is a drag to growth in the fourth quarter. So I think the trade data are basically telling you strong consumer spending in goods, and we do indeed import most of that. So I haven't seen evidence in the data yet of stockpiling. That doesn't mean that there's not going to be some bringing forward of spending by companies there, but it's not in the Q4 data.
Well, Blerina, just to sort of broaden
we go back to the consumer and the labor market that is supporting that spending.
Blerina, just to sort of broaden that out, there has been this sort of push-pull about whether we're reaccelerating or we're actually seeing some sort of weakening in the overall economy that will lead the Fed to keep cutting through the remainder of the year. Yesterday, we saw consumer confidence take a hit. It came in much lower than expected. There has been this increase in expectations of job insecurity. Blerina, do you reject that? Do you sort of focus on the consumer and consumer spending as being the more dominant tell of the strength of the U.S. economy?
I have to say I remain quite positive about the U.S. economy. We are seeing some signs of loosening in the labor market and deceleration in growth. I think growth in 25 is going to be slower than last year, but it's not going to be weak. Employment growth is solid. There is job security, no signs of mass layoffs there that would make workers worry about the outlook of employment. Of course, we're hearing now about federal government employment, but the majority of employment in the economy is provided by the private sector. So I think we still have a strong economy. And I don't see, even though there may be some wobbles in terms of consumer confidence, I don't see consumers really holding back so far.
Blerina, how much, when we talk about the pause or the skip, which is going to be the exciting moment of the news conference later today with the Federal Reserve, will they indicate this is just a break in a downward path of rates, or potentially this is it? What are you looking for in terms of where the emphasis is, and where would you land in terms of that debate?
So I expect to learn nothing from this press conference. And I think that would be a measure of success for Powell, that he doesn't give anything away. And so what that does is to leave us watching the data. So when the Fed started cutting interest rates back in September 2024, they were really worried about the labor market. cooling rapidly, the unemployment rate increasing. What we've seen since then is a pickup in employment growth and a decline in the unemployment rate. So that reason that pushed them to cut by 50 basis points in September last year seems to have moved in the opposite direction. Now, maybe they want to take credit that they helped stabilize the labor market by easing policy and financial conditions, or maybe there is underlying strength here and the data over the summer was just a bit noisy. We'll see. But I think essentially now the only reason that the Fed might have for cutting interest rates is this idea that where we are right now, monetary policy is restrictive and we want to gradually move towards being neutral because you don't want to stay restrictive for too long, especially with inflation coming down quite significantly from the 2022 levels. Now, the problem here is if the economy is not weakening and progress on inflation is relatively slow, what's the rush? So I think that leaves me with the Fed is wanting to cut interest rates. It has a dovish bias, but the economic developments don't support it to cut interest rates in the near term. And then we have all the policy uncertainty coming from the new administration. So I have to keep an easing bias in my rate forecast, but I'm thinking at the earliest interest rate cuts will come in the second half of this year.
Manchester City versus Club Brugge at 3 p.m. Eastern Time, if you're interested. Okay.
Yeah, you know,
watch the build up to the game
I love
as well.
it. Okay,
News
can I just say, you start the show, we're so excited. It's going to be an incredibly important Fed decision. Just wait. And we have gotten so beaten down in 37 minutes.
Hold on a minute. I don't think I ever said that.
You did. You sounded excited.
If I said that was
Pure
very
sarcasm.
disingenuous.
Oh, I know, but you did.
I'm sure
but
everyone could feel the sarcasm.
4 minutes we spent talking about it.
Yeah, 4 minutes too many. Blerina, thank you. Blerina Uruci there of T. Rowe Price.
Thank you for having me.
No one thought I was being serious.
I did.
You thought I was being serious.
I took you so seriously.
You thought I think this is a big Federal Reserve decision.
I think you're really excited for it.
Look, I think with Chairman Powell, he's capable of anything. And he could flub this one too.
Well, that would sort of be his to flub because, as everyone's been saying, it's expected to be incredibly boring, and that would be the successful way for this news conference.
We can set up a screen over here. I can log into my Paramount account, and we'll make it happen.
You're going to be watching.
Yes.
You're going to be watching football.
2 screens.
2 screens.
Chairman Powell, bit of football at the same time.
This is quite the promo.
Mike McKee can't do that. He'll be in the room. Mike McKee, for Chairman Powell today, it feels like a non-decision, no decision to make. They're not going to cut interest rates. They're certainly not going to hike. What do you expect them to do?
What time does the football game start, John?
3 p.m. Eastern time.
we might watch it in the briefing room. I don't expect him to do much of anything. I think everybody's been telling you that today, that the Fed wants to get in and out of this without making any news. There's enough going on. The Fed has enough headaches without provoking the president even more. You know Jay Powell's going to be asked about it, but he'll probably dodge that question. The only thing that markets might get out of this, or that they're really looking for, is any kind of hint about what might happen in March, and I suspect we'll miss that too. There is one area in which they could make news, and that's the Fed balance sheet. They're expected to stop QT sometime this year, and they haven't given any clues to anybody about how and when. So with nothing else on the agenda, they might be able to put something out on that today. We'll take a look for that, and that might be the best that you get, unless the football game's exciting.
It will be. Mike McKee, thank you. If they lose, if they don't win, they go out the Champions League. This is a big deal. Manchester City.
I'm going to be looking at the balance sheet.
And not Manchester City and the future of Pep Guardiola.
Yeah,
okay.
Well.
Krishna Memani follows the Fed very closely. Joins us now from Lafayette College. Krishna, it's good to see you.
Good to see you as well.
Can you make this afternoon interesting?
Well, no, I mean, if you think about it from the Fed's perspective, everything is kind of working out according to plan, the way they laid out the plan in the last meeting. And nothing has really changed, which is growth is really good, and the inflation is coming down, but at a very slower or much slower pace than they would probably like. But they are worried about the labor market and don't want to cancel that optionality. What they're not worried about is significant pickup in inflation and therefore the need to tighten. I think that is really the one point. If I can see anything come out, that probably would be one point.
So skip or prolonged pause sounds like skip for you.
Absolutely, skip is the right way to think about it, because anecdotally you can come up with a lot of talk about labor market softening. But it really, at the aggregate level, it really isn't. So they want to cut, but they don't have the opportunity to cut, and that's where we are.
So you expect them, and Krishna, this would actually be real news, you expect them to completely remove the possibility of an additional rate hike from the table at a time where some people are saying that could potentially be the big issue later this year.
So what I would say is that they would never kind of take it out altogether. But I think if there is some tamping down to be done, it probably is on that front so that people don't expect that they are on a pause for a very, very long period of time with the possibility of rates going up. That doesn't really serve their purpose because they are focused on the labor market. They're not seeing the weakening, but they're worried about that weakening.
So it seems like we can't really get forward guidance at a time where the Fed is not in the pole position when it comes to understanding the trajectory of inflation or when it comes to policy. So how potentially disruptive could they be if they take a decision that is counter to what the markets basically are implying?
Well, so I don't think they can be very disruptive. The markets today are being driven by other things other than the Fed. Fed is, of course, a larger context in the market, but I think what you're dealing with right now is what happens in the equity market with AI and other stuff. And that thinking is dominating everything, and that is probably going to be with us for a while. So, if you think about it from a market convexity standpoint, the convexity profile is highly negative. That is, the upside is broken because of the break in the narrative, and the downside is quite significant. So if bonds move a lot, it wouldn't be because of fundamental data, it'll be because equity markets have corrected a lot, or the Fed said something. Or it wouldn't be because of the Fed said something. It's going to be driven by what happens in equities, the way it happened on earlier this week. I think that is going to be the driver rather than the Fed or even earnings for that matter.
I've known you a long time, and over the last decade since I've been in this country, when we have these turning points in markets, I've sat down for lunch with you and you've gone through what's about to happen. I have to say, your track record, in my experience, has been absolutely phenomenal on that front. Do you believe that was a big turning point for equities on Monday?
Oh, absolutely.
Why?
Absolutely. So, again, people make it out of, well, AI is still going to progress and the cost has come down. It's none of that. I mean, all of that is still very much in place. The fact that DeepSeek can come up with a lower cost model doesn't change the overall fundamentals. What it changes is your valuation thinking. That is the super premium that you were willing to pay because you thought that it could run even more. That is what you're questioning. And therefore, I think it's not because any technological development. It's really more about market sentiment and how they feel about paying 100 times or whatever on various stocks that they are willing to pay based on a certain narrative.
You say various stocks. Do you mean the whole universe of equities, or do you mean certain pieces of the AI story? Is it the energy piece of the story? What is it?
I think there's a lot of stuff that went up on the back of AI. Energy, quantum computing, cash flow producing entities, the downside on them is much less. On the other hand, anything that was based on capital spending on the back of the AI wave, I think you have to question that. It's not that Meta is going to become less profitable. They are hugely profitable and they can generate good earnings, but kind of speccing on quantum computing, expecting or data centers and the demand for electricity and nuclear producers and things like that, those are the sort of things that we have to question.
How much did you shift some of the allocations that you have as a result of that potential tipping point, that nuance in the AI adoption cycle?
Well, so, we didn't shift much because we never loaded it earlier. So, it was what we did was not rebalance the portfolio and let the equity market run. What we are thinking about now is to rebalance the portfolio on a consistent basis, far more than what we would have thought earlier, because now it is about risk management. It's about protecting your downside because, as I said, the convexity profile is very negative at the moment.
You said something else that I thought was instructive, that the bond market's going to move more responding to earnings than it will to the Fed. What do you think could happen, and what's your interpretation of the fact that bond yields went down on Monday? Is it the idea that potentially broader adoption of AI would be disinflationary? Is it just a risk-off trade that bonds now have the same relationship as they used to have pre-pandemic?
Well, so I don't want to kind of oversell that particular idea. I think the fact that bonds only went down 10 points when NVIDIA lost $500 billion sort of gives you an idea as to the magnitude of that particular. I mean, bonds have headwinds too. It's not that they're free. When you have 3% growth rate, expecting 10-year to get to 3.5%, I think it becomes very, 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 very challenging. But the point, however, that I would like to make is, one, don't have a view. That is really not helping you at the moment. And second, if you have a view on the downside on bonds rather than upside on equities. That's how I would kind of characterize it.
So take a view right now. Do you remember Bloomberg real yield? Rapid fire at the end. 450 right now on 10s. What do we hit first? 4 or 5?
Oh, 4 rather than 5.
4 rather than 5?
Yeah.
Krishna, appreciate it. It's good to see you.
Thank you.
It's a lot locked into that answer about where you think this market's going, right?
I love it. You really you miss it. We should do rapid fire.
But honestly, it's too much, Brammer.
Yeah, but I hear you. But you could have said 4.4 or 4.75. That would have been
stretch out.
I know you want to make it that much bigger, but
sure.
We were talking.
All right. Okay. Can we move on? We good? It's good to see you, mate. As always, thank you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Bloomberg has learned that Microsoft and OpenAI are investigating whether Chinese AI startup DeepSeek obtained unauthorized data output from OpenAI technology. Sources say that Microsoft had observed individuals that they think might be linked to DeepSeek taking a large amount of data using the OpenAI API. Earlier, the White House AI chief, David Sachs, told Fox News that there was evidence DeepSeek had leaned on the output of OpenAI's models to help develop its own tech. Bloomberg has also learned that Apple has been secretly working with SpaceX and T-Mobile to add support for the Starlink network in its latest iPhone software. In an under-the-radar move, the smartphone's latest software update released this week now supports the technology. The initial version of Starlink is exclusively for texting, but SpaceX and T-Mobile had previously said that they plan to expand into data connections and voice calls in the future. Novo Nordisk's popular weight loss drug, Ozempic, has been approved by the FDA to treat chronic kidney disease in patients with type 2 diabetes. Studies have shown that Ozempic can reduce the risk of death in patients with kidney disease caused by diabetes. Novo Nordisk shares, for their part, are getting a slight boost, 0.7% in the Denmark trade. And that's your brief. John.
Hey, Danny, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the trading day. We'll catch up with Manus Cranny, get you some movers, and then we'll head down to Washington, D.C. to catch up with Annmarie on the Federal Reserve, because the politics of this could be more interesting than the decision itself. That conversation up next. Equities just negative by a third of 1% on the Nasdaq. We're just about unchanged on the S&P 500 with some morning movers. It's Manus Cranny. Hey, Manus.
Jonathan, let me just give you something pretty spectacular. This is DJT, up 16%. They have developed their financial services strategy in conjunction with Charles Schwab. Yesterday it was X and Visa. Today it is DJT. It's about putting $250 million into a fund. It's going to be a new company called Truth FI. It's about America First, about the capacity to invest in vehicles, ETFs, managed accounts, along with crypto. I mean, look, this just reminds me of the Apple Pay moment from many, many years ago when people were trying to understand what's Apple doing? Why do they want to get into financial services? This is the wallet that everybody is going after. Alibaba, let's just give you a snapshot of this. Your lexicon's going to have to expand from Quen 2.5 Max to F1. All of the AI names are going to have to be learned a little bit more about. This is Alibaba delivering an upgrade to their AI, a superior model to that of DeepSeek. This story is now not about China versus the United States of America. This is about open source versus closed source, up 3% and change. Jonathan.
Manus Cranny, nice work. One to watch. Going into the opening bell. Lots of data and lots of earnings through the week as well. Lots of central bank decisions at 2 p.m. Fed rate decision followed by a Fed chair J. Powell news conference at 2:30, plus earnings from Microsoft, Meta and Tesla. Thursday, an ECB rate decision, jobless claims and results from Apple and Intel. Friday, PCE. Saturday, President Trump's tariff deadline. Let's head down to Washington, D.C. and catch up with Anne-Marie. AMH, we all want to know, when we get this decision and the news conference starts, will the tweeting, will the posts begin on X from the President of the United States?
Potentially, and if history is any guide, we could see that as Jay Powell has his first press conference today under Trump 2.0. Remember in 2019 when he didn't lower rates, Donald Trump blasted Powell and said potentially the chair of the Fed was even a bigger enemy than Xi Jinping. Here is what we know already that President Trump has said. This is really a commander-in-chief who thinks he should be a Fed chair. I think I know interest rates much better than they do, and I think I know them certainly much better than the one who's primarily in charge of making that decision, a.k.a. Jay Powell. I'd like to see interest rates come down, quote, a lot. We know where his mind is. We know that the Fed's not going to deliver where his mind is. So you can expect there's likely going to be some tension today.
Annmarie, I think a lot of people are expecting that. He's a real estate guy. What do we expect? He wants rates to be lower. Annmarie, going forward to Saturday, what are we looking for to know how real this is and what this says about the path ahead in terms of tariffs?
So this is really a self-imposed deadline. Trump kind of threw it out there when he was briefing the press last week. But Caroline Leavitt, the new press secretary, had her first briefing yesterday with reporters and said that's still in the books, February 1st, when it comes to China and Mexico. I thought my conversation earlier was telling with Kellyanne Shaw, who was in the room, who negotiated phase one trade deal with China. And she says, I believe these are real, especially on Canada and Mexico, because Trump is really taking this what he calls America First agenda. And when it comes to Canada and Mexico, a lot of this has to do with immigration and fentanyl coming through the border. What is more telling and interesting, potentially we'll learn from this weekend, whether or not these tariffs come or not, is China included. He has talked about 10% on China. Regardless if we get them all this weekend or not, there is a memorandum looking into things even like currency manipulation, trade deficits, who is playing fair rules when it comes to trade for April 1st. And his entire team is yet to be in place. So the direction of travel is very clear. I just think the timeline is a little bit more murky, and he has been more ambiguous on places like China.
Anne-Marie, appreciate it. More from AMH through the week from Washington, D.C. Coming up a little bit later, join Lisa at 1:30 Eastern Time. Very excited about this.
Because it's going to be an awesome lineup, and it's going to be an awesome press conference. The Fed decides. Surveillance special.
Mohammed Al-Arian, Bob Michael, Diane Swonk, Jeff Rosenberg, and more.
And
from
Jonathan Ferro.
New York City. Maybe. This was Bloomberg Surveillance. This is Bloomberg TV.